offer. The other one I've got my eye on, Guy, is Stellantis, actually. It looks like they now have their head of production over at Rivian is joining the company. We know that Stellantis has been dealing with some potential strike action, again, from the UAW ahead of the DNC. Sean Fain, of course, the president of that union, making an appearance there. We'll see what that actually looks like when it shows up in those Stellantis shares. That's the one I've got my eye on, Guy.
There's going to be some exciting single stocks to watch out for. Let's talk about the index, though. Let's figure out what's going to be happening here. It is time for the opening trade. Let's show you what the numbers look like. There is a big drum roll, and then we get the numbers. There you go. The FTSE 100 is flat. Absolutely flat. Flat as a pancake. Could not be, it's really struggling. We're in and out of positive and negative territory. The Stock 600 is out of the gate. It is up by 0.03%. It's a fairly flat open, I think we're talking about here, folks. We've had a really good risk rally. Equities have been driven higher. We came off the floor of the volatility we saw earlier on in the month. We've rallied hard off the back of that. Nothing goes in a straight line for too long. This morning, we're certainly seeing evidence of that. The European equity market open, I am struggling for superlatives, Chrissy.
Well, I'll give you a couple. Momentum. And some of them, whereas the momentum has perhaps a little bit kind of faded that you have seen over in the States, and we saw them in the Russell, we saw them in the chip stocks, it kind of feels like it's showing up, at least in this kind of low volatility, low liquidity environment, low volume, I should add as well, for one more term. It's showing up in those big mega cap stocks. So, for example, your big index contributors to the upside on that Stock 600, even though there's marginal gains, are coming from your heavyweights. It's coming from SAP, for example. It's coming from the miners. It's coming from Novo Nordisk. Even ASML is in your top index movers. So really, I think when you see some of those mega cap names move to the upside, that's really where you kind of see that, okay, well, people are just sticking to the safe plays, it seems like. There's a downside, though, Guy. That's where you're seeing some of the commodity names take a hit. And I think this is important here because you're seeing Shell, again, your biggest index weight. We saw that in yesterday's session as well. BP is dragging as well, despite the fact that oil is marginally higher this morning. We're seeing a 77 handle when it comes to Brent crude.
Waiting to see some volume numbers. I suspect they could be fairly diminutive.
You're killing me. You're killing me. I'm trying to get everyone excited, and you're
Rio
killing
Tinto
me.
is higher this morning. The miners bounced back. The
There it
quality
is.
story is there. Diageo, we are seeing some strength there. Novo Nordisk is rising as well. In terms of the downside, some of the farmers look like they're a little bit weaker this morning, which is interesting, actually. We've just been talking about what the story looks like out of Denmark, but it looks like that is where we're maybe seeing a little bit of weakness this morning. Let's dig into this in a little bit more detail. I know we've been watching what the house builders have been doing as well. That's a very kind of UK-related story. But in terms of where we're seeing the points being added and taken away this morning, as Critty says, commodities are up. ASML, SAP is doing reasonably well. Downside, Alcon is down. It's got numbers out this morning. Shell, a little bit of weakness there. But the pharma sector actually is maybe where the weakness comes through. I think there's been a downgrade in the gambling stocks as well. I think Entain under a little bit of pressure.
Well, speaking of some of the home builder stocks you were mentioning, a quick check on those as well. Barrett Development's kind of flat on the session at the moment, but you are seeing gains show up in Redrow, higher by about 0.6%, so perhaps that reacting to what we're seeing in the CMA announcement.
Let's talk about what does better from here. I think it's hard to judge on a morning like this. Bonds or equities? We caught up with Caroline Shaw, multi-asset portfolio manager at Fidelity. She kicked off the show a little earlier on with a mildly optimistic tone when it comes to equities.
The bond part of the portfolios maybe looks a little bit more attractive on some measures now, but we still think that fundamentally corporate balance sheets are strong and there is room to run in the equity market still for the second half of the year.
Caroline Shaw joining us from Fidelity. Our next guest, kind of in the same camp. Goldman Sachs' Peter Oppenheimer thinks risk assets have a good foundation to make steady gains from here, adding that he favors European equities with high revenues exposure to the United States versus those with high exposure to China. Joining us now is Peter Oppenheimer, Chief Global Equity Strategist at Goldman Sachs. Peter, great to get your take on what is happening with the world right now. We've had a decent rally over the last few days. Equities feel like they've run out of a little bit of steam this morning, but you still think we can make gains from here. What is the motivation for those gains?
Well, I think we have to differentiate between the very short term and the medium term. As you say, we've had a very strong rally after a pretty violent correction. And I think that's a reflection of an adjustment back to less concerns about recession and more hopes for interest rate declines. And I think that's really what is going to set the tone for the second half of the year. We don't expect very strong returns because valuations are relatively high. But I think the default position is that when you're getting interest rates coming down in the absence of recession, and that would be our central view, equities generally make pretty decent gains and tend to outperform other asset classes. And I think that's the sort of central tendency that we're likely to see over the next few months.
How close is it going to be between bonds and equities, though? Which one of those? You sound like you think equities are going to outperform, but how close could it be?
I do think so. We've already seen, a rally in the bond markets as interest rate expectations have adjusted again. I think there's a limit to how far longer-term bond yields come down, however, partly because with ongoing strength in the economy, there's going to be some term premia still reflected in bond markets, having come out of an era over the last decade or so of extremely low term premia, reflecting very, very low inflation. And secondly, of course, we are in an environment structurally where government deficits are rising and borrowing continues to increase. And I think, again, that's going to limit to some degree the extent of any declines in longer term yields. So it's a reasonably benign environment, I think, but not a spectacular one for both equities and bonds. But I think equities look more attractive on balance.
But Peter, what would the kind of next leg of the rally that may come from the equity market, is it coming or is it responding from an economic resilience story that's showing up in earnings and corporate profits, or is it showing up from expectations of a rate cut, which would kind of imply the exact opposite? What do you think?
Well, the setup, I think, here is reasonably positive because the interest rate declines are likely to come principally because inflation pressures are moderating, and that's giving the ability for central banks to cut rates without the fear that they would have had a year or even 6 months ago. Of course, any urgency to cut rates on the back of declining growth is probably going to be more negative for equities, and I think that was the concern a few weeks ago. But our view is that those concerns were overstated. And actually, if anything, we think that growth in the second half of this year, economic growth, at least in the US, will pick up a little bit. And the particularly weak labour market data that we saw that was one of the triggers of the July correction in the US is likely to be less negative, we think, in the next report. So the balance here, I think, is of moderate positive growth, not spectacular, and steady, consistent drops in interest rates. I think if you were to see more aggressive cuts in interest rates on a basis of growth deteriorating more quickly, that would be a more negative outcome for equities.
But talk to us then about, we had a guest on just earlier in the show who was saying that the kind of cash balance sheet that so many of these companies, and we're not just talking about the trillions that some of these mega cap tech companies are sitting on, but even other members of the S&P 500 provides a cushion and actually kind of could de-risk against some of that sensitive or interest rate sensitivity. Where do you stand on that? When does that run out, that cash cushion that has really been a function, it feels like, of the post-COVID era?
Yeah, and we should emphasize that cash cushion is being true in the corporate sector because, in general, corporate balance sheets are strong. It's been true for a very long time in the household sector because households built up unusually high levels of savings during the pandemic. A lot of that has been unwound in the US, but not really in Europe and other places, and that continues to be an important support. And then, of course, we have strong balance sheets in the banks, and I think that's an important underlying structural support for financial markets as well. Look, our general view has been to support stronger balance sheet companies over the last couple of years in an environment with sharply rising rates. Every time we get speculation that rates are going to fall, you get a little bit more uptick in more weaker balance sheet, perhaps higher beta, more leveraged parts of the market. But overall, we still think that quality, strong balance sheet growth compounders are likely to continue to be a dominant part of what leads the market over the second half of the year.
Peter, why do I want to buy European stocks with US exposure? Why don't I just buy US exposure?
Well, guys, great question. I mean, we're certainly not saying that you should be buying Europe over the US. One thing I think is important to emphasize, though, is that European stocks, which happen to be based in Europe but have very high exposure to the US consumer, do tend to be quite a bit cheaper than their counterparts in the US. So what we're really looking here at is perhaps more diversification than many investors have been used to. Bear in mind that the global stock market has been very dominated by the US market over the last 10 or 15 years, and at the same time by a very small number of US companies. And that does leave some risk of idiosyncratic disappointment in any of those dominant parts of the global market. So what we're really looking at is how you can diversify to improve your risk-adjusted returns over time. And I think that does include some of the companies that have got good revenue exposures, but maybe in areas where they get a valuation discount.
Peter, one of the areas that we're increasingly hearing about around this table is the FTSE 100. A lot of people have been talking about it. I read some of your notes around this issue. The issue with the FTSE seems to be actually less to do with international investors who seem to be largely on board with it, as you point out. Why don't the Brits like the FTSE? And is it just the sort of diversification trade that's keeping them away from it? And is that going to change if everybody else seems to finally fall back in love with that market?
Well, I think the principal argument in support of the UK is that it's a very cheap market. And of course, that has been true for a very long time, partly because of its particular sector exposure. If you look at the FTSE 100, for example, it doesn't have any large tech stocks in it. And tech, of course, has been the dominant sector in the global equity market for a very long time. But notwithstanding that, if you look at companies in the UK and like for like with those in the US in the same industries, it's a lot cheaper. That did reflect, I think, a long period of very weak growth in the UK, and that weaker growth environment is improving a little bit. There's a much more stable political backdrop, given that we've just had an election and there's a government with a big majority, and I think that builds some confidence. But also the companies in the more value-orientated sectors in the UK are very cash generative. They're paying dividends, they're buying back shares, they're compounding returns for investors. We think that's attractive. The constraint, I think, for domestic investors is more that the big insurance and pension funds have largely de-risked from equities, partly because of regulatory conditions over the last several years. And therefore, there isn't the scale of domestic buyers really to dramatically move the index overall. And therefore, the biggest buyer itself is the corporate sector with buybacks, and at the margin, foreign investors coming in to take advantage of that discount. We think that will continue.
Peter, you said two of my favorite words there, dividends and buybacks. But I'm curious when you start to see a little bit more action show up in things like capital market activity, specifically in Europe. We talk a lot about kind of weakness in the IPO sector here in favor of New York, but it still feels like mergers, acquisitions are very much on the table, given the cash cushion we discussed on both sides of the Atlantic.
Yeah, I would agree with that. I think the backdrop, the setup is actually pretty attractive for an increase in M&A and indeed IPO activity. In the end, it's most affected by confidence and sentiment and, of course, interest rates. And all of those things at the margin, I think, are improving. The problem that the UK has, as with the rest of Europe, really reflects again the scale of domestic support and the depth of liquidity that you have in the European markets relative to the US. And this becomes a bit of a sort of compounding constraint on new issues, because obviously companies want to be issuing equity in the biggest capital markets with the most depth and liquidity. Ultimately, though, I don't think that's going to be a binding constraint, and we would expect to see, as interest rates begin to come down and confidence in the global economy continuing to gain pace, for there to be more corporate activity. And of course, these things tend to be a flywheel effect. As you begin to get these happening, I think more will come through. And we're in the middle of the summer. As you said, it is an extremely quiet day. I would expect that activity to pick up as we come out of this summer season.
Peter, it's always a pleasure. Thank you very much indeed for joining us this morning. We greatly appreciate it. Peter Oppenheimer, the Chief Global Equity Strategist at Goldman Sachs. Thank you very much indeed. Let's talk about some of the chief European equities. As you can see, they all appear to be in the green. We've just seen LVMH turning positive, but not by much. Novo's up around 0.5%. Luxury, which has seen a decent gain over the last few days, fairly flattish. Tech's having a decent day. Nestle fairly flat as well. There's nothing really, I think, to write home about within some of those names there, but we will keep an eye on them, as those are the ones that are moving. We're not seeing a huge reaction in UK house builders this morning.
Not a massive one, or at least the one that we did see has been pared back a little. And this really coming off of the news out of the CMA, this UK antitrust watchdog, talking about the potential merger between Barratt Developments and Redrow will actually go through, but they are likely to accept the remedies offered to them around some of the initial concerns of the deal. But it looks like Barratt is flat. Redrow was up almost 0.6%, pairing some of those gains now, only higher by 0.2% now.
Market looks like it's got on board with that one. Let's talk a little bit about what is happening with the mining stocks this morning. I take you back to what is happening within the commodity space. We were referencing it a little bit earlier on. You are seeing the Chinese steel trade bouncing back a little bit today. Iron ore's come up as well quite nicely, in Asia, up by about nearly 4%. That's being reflected in some of the mining names this morning here in Europe. And as you can see, we are seeing something of a bounce back. These stocks have been under a little bit of pressure, as we've seen some of these metals come under real pressure over the last few weeks and months. Iron ore in particular has been front and center there. But today, some signs maybe of stabilization.
So green on the screen there. Another stock that we've got our eye on is Stellantis. And this is an interesting one as well because it's higher by 0.5%. It looks like this is a personnel move that seems to be moving the market here. The head of production over at Rivian, North American Manufacturing, Tim Fallon, is now joining Stellantis. This is a pretty big deal. We know Stellantis had a lot of trouble, especially when it comes to some of the manufacturing delays driven by some of the union action. There's been threats in the last coming days in the lead up to the DNC from the UAW, the major union, the auto union as well. And it looks like perhaps this might be some very welcome news for a stock that's taken quite a beating.
We talked about Nestle earlier. Let's talk about eye care. Alcon out with numbers this morning. Q2 numbers look like they have missed a little bit, so the shares are dropping. This stock is down by around 0.9% at the moment. Down a little bit earlier on, more than this. It was down in late US trade as well. We've seen that replicated first thing this morning. So we are now seeing this company under a little bit of pressure this morning in terms of the European space. We were talking about Danish pharma stocks. It's interesting in the kind of the bigger picture story as to what is happening here. And we were talking about that a little bit earlier on to Sarah, but it's fascinating to see just how big an effect they are having. And we're going to be talking to Zealand Pharma. No, we're going to be talking to Bavarian Nordic a little bit later on. Not us.
Not us. Zealand Pharma is having quite the move, higher by 1.2%. Novo Nordisk, though, kind of in on that trade. I'm curious how much of that is just on a very quiet day. You mentioned the sensational six. None of the other mega cap stocks are moving by this kind of margin. I'm curious if that's a little bit of the read-through. And then Bavarian Nordic, to your point, down about 5%.
Let's take a look at what we're happening in terms of the futures. US futures mildly positive at the moment. This feels like firmly a sit on your hands kind of a day. Doesn't seem like even the single stocks that we thought may be providing some excitement, and maybe Bavarian Nordic is one of the few exceptions out there. We're not seeing some huge moves. I think the iron ore trade is interesting. That's being sort of fed back into what we're seeing with some of the mining stocks. That's providing a little bit of support for the FTSE 100. But I say a little bit. I mean, nothing is happening here.
Nothing's happening. Quick correction, though. Our interview is actually with Zealand Pharma at 9:15 a.m. But it's going to be the similar story, isn't it? rollout of the vaccines, how they're diversifying, how do they get this, who's their audience. And this is, I think, a really interesting dynamic that post-COVID, the reaction function is significantly faster than we used to see, say, 5 years ago.
So what gets this market moving again? What is it? Is it Powell?
I don't think it's Powell.
Okay, so why not?
I don't think it's Powell because what is he going to say?
Exactly.
It's going to be the same data dependency story. In fact, I think it might be the labor market revisions that you've been talking about all morning, actually, at 3 p.m. UK time, I believe.
But if Powell says nothing, is that a catalyst in itself? In as much as the market, maybe some are optimistic that maybe he gives clues, he signals September and that's enough. The fact that the rate cutting cycle is going to be beginning and it's going to be a reasonably benign start to that rate cutting cycle, kind of pointing us towards 25 basis points. That's the kind of Goldilocks environment.
I mean, do we care about the September cut? That's largely priced in. I feel like we care more about what happens in November, December.
Sure, but you've got to start somewhere.
Sure, but I think there's also a question of if you start once, is that a cut, skip, cut cycle? Like, what does that look like? The Fed doesn't usually do that. They're usually consecutive.
Yeah, maybe you start strong and then you move to that more sequential kind of normal.
There's even a camp that talks about 50 instead of 25.
Yeah.
We'll see if that happens.
We'll see if that happens. What would that signal if that was to be the case? Coming up, Chinese EV companies reporting numbers, EU ramping up its tariffs. These two things seem fairly antagonistic. We're going to discuss the outcome next. This is Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
The two companies that combine for most of the EV exports get the lowest speeding ticket. So what the EU is signaling is they don't want made in China exports. They would rather have the Chinese supply chain and the Chinese capacities moved into the European Union. Tesla, you've got a factory in Berlin. Why not build your cars here? BYD, you're going to build a factory in Hungary. You like that? You get a lower speeding ticket. So it's actually an invitation for Chinese companies to bring their capacities closer to the European Union.
Automobility founder and CEO Bill Russo there discussing EU tariffs on China-made EVs, certainly something, of course, that's moving the markets. The European Union planned to introduce an extra 9% tariff on Tesla's imported cars from China. It's the bloc's latest move aimed at countering subsidies coming out of Beijing. Let's get more on the story. Bloomberg's Oliver Cook joins us out of Berlin all over this story. Ollie, walk us through the latest twist in the road for EU tariffs.
Yeah, Credy, so we got the revision from the EU in terms of the latest numbers of the number of specific percentage tariff that we get for each of these automakers that produces car in China and what they will pay in order to get those cars into the EU. These numbers have been changing a little bit. Broadly speaking, these are numbers that have been brought down very slightly across the board and substantially for Tesla. Let me just take you through SAIC, for example, which is on the very high end of this, the Chinese automaker, with a tariff of 36%. That is really on the higher side. That's down from 38%. You have Geely that owns Volvo, that's getting a 19% tariff, again, down from 20%. And BYD, really the main player and the main concern for European car makers as far as competition is concerned, they're getting a 17% tariff. Now, you take all of that into account and you look at what Tesla has got now at 9%. That is down from something closer to 20% from what had been anticipated. Tesla had already been raising prices in Europe on their Model 3s in anticipation of that. And the reason that the EU has revised this down is they say that a lot of the foreign car makers, i.e. the European ones that produce within China, benefited a lot less from some of the subsidies that the Chinese government was providing. But Tesla did benefit from land use rights, income tax reductions, and there are a bunch of different grants, including a grant for companies that produce in China and export, which of course the US and EU cannot be too pleased about. But also BMW, they make their electric Mini, for example, they make it in China. Tariffs came down on that. So all of this is going to continue for another couple of months. The EU is going to talk with some of these car makers going forward, and it really comes to an end on October 30th with the final deadline. And whatever is decided there, the tariffs that go into place will last for at least 5 years. So it's really crucial for everybody to get this right.
I look at Geely's numbers this morning and I see very strong exports. Have the Chinese companies been front running? How are they building up stock in Europe in advance of some of these tariffs coming into place?
Yeah, there has been a lot of reporting, Guy, around that, and there has been some data that would indicate that a lot of these car companies have been trying to just move a lot of this inventory before these, the final tariffs come into force. But of course, some of them already have. So, again, they were front-running this. They were anticipating issues throughout the years. We know this from the very beginning. But as you say, Geely is an interesting example. We had the numbers out. I mean, they had a record first-half profit. They had, again, that was down to exports. Their vehicle deliveries were up by 41%. They raised their sale targets to 2 million this year. And again, if they're really going to be dependent on that export growth as the driver for their growth, given the sort of how difficult things are in China, not just because the economy is slowing down, but because EV competition is so great, 19% tariffs is going to have a material impact. And I'll just leave you with one note that only 19 of China's 140 companies in the EV space are expected to be profitable by the end of this year.
Ollie, great stuff. Thank you very much indeed. This is Bloomberg. Gold's next.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
DOJ or other authorities.
Could face bigger challenges. Next.
It was going to keep reading World Cup. This is a story
As the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
This is the opening trade. We're 30 minutes into today's session. Seeing some green on the screen when we look at the broader equity markets. Your stock's 50 higher by 0.2%. But again, light volume, light liquidity. That's kind of all I have to say on the markets. Instead, I'm going to get to some breaking news here. Looks like China's starting an anti-subsidy probe into the EU dairy product imports. Already seeing some market reaction in Danone shares. Of course, the French company, those shares down by about 2%. We're going to keep you apprised of that. But of course, this comes on the back of some of the other trade stories that we're seeing between the EU and China.
Well, this fits into what we've just been talking to Ollie Crook about. This is the direct reaction. And I would imagine they're targeting the French dairy industry. That appears to be an area that I suspect that the Chinese are looking at here. We've seen in the past the French describing Danone as a strategic company. That was many years ago, but it kind of resonates, I think. So they are clearly looking for areas that they can target the Europeans on in response to what we've seen in the auto sector. Ollie Crook just joining us to talk about that. So we're starting to see the reaction to all of this. Danone is down by 1.65%. Yogurts is going to be part of the trade war, it seems, between China and the Europeans. How does that feed into the next story we're going to talk about? This does all tie together, believe you me. I can draw some dots here between the stories that we're covering. You've got Ollie Crook talking about what's happening with the autos. We're talking about Danone and the Chinese and the response to that. That takes us to our next story, which is talking about global shipping and what is happening with the global ports that are developing really quickly around the world in certain key areas, but are now very much getting caught potentially in the crossfire of this intensifying geopolitical trade tension that we are seeing. So the Bloomberg Big Take looks at this today and how ports have turned into strategic battlefields and how global powers are using them to defend their economic interests. To talk us through this, Bloomberg's Brendan Murray joining us around the table. It's kind of perfect time. We've got the auto story. We've now got the Chinese responding with the Danone story and what's happening with the dairy industry. This takes us perfectly to your story on the ports. You sat down, and it was a stat that stood out to me when I read the story as well. 7 out of 10 of the biggest ports in the world are in China, right?
That's right, yeah. And how many are in Europe or the U.S.? Yeah. 0. So, yeah, if trade is a battlefield, ports are really on the front lines of what's going on, not only in the geoeconomic disputes that are playing out between the U.S. and China and the European Union, but it's also they're transforming to digital technologies. They're decarbonizing. So ports are really $200 billion worth of investment a year for the next decade is the figure that we report on today. That's a lot of money going into port infrastructure and the industries that congregate around ports.
Talk to us in the context of some of the issues that ports have been facing. Union workers have been one of them. Wages have been one of them. But then in the broader shipping industry as well, you have lags on fuel, the tensions in the Red Sea. How does that show up when it comes to congestion in some of these ports?
Yeah, well, it can really, well, we're going to find out in the U.S. right now. There's the dock workers on the East Coast and the Gulf Coast those talks, their contract talks are in an impasse. They're hung up over automation. So new technologies going into ports to make them more efficient, make them more productive, is really playing out with the workers there. Ports are also, decarbonizing all those pipelines that we and electrical grids that run through them, are being overhauled. So that's another big part of the investment that we're seeing.
So you've got China, a major focus, but you've also got Africa as well. Somaliland is an area where we're seeing particularly the Gulf countries stepping up and creating a huge footprint. Like Dubai, ports like that have always been big import-export ports, but we're seeing that kind of slightly shifting around in terms of the geography. How does what's happening in the Red Sea feed into that? How does the regional politics feed into that? How big a kind of setup could we see ultimately in East Africa?
Yeah, well, in the past 6 months, as you mentioned, the Red Sea turmoil, the attacks on ships have rerouted a large portion of global trade shipped from east to west. That's been absorbed for the most part. Shipping rates went up, but now they're coming back down. So we're seeing strategic investments in ports in Africa, like you said, Somaliland and elsewhere. These markets where consumer spending is growing, a burgeoning middle class is happening.
Yeah. But is that an import-export story, or is it they're there to fill domestic demand?
Well, ultimately it should be both. The emerging markets, they want to export their way to prosperity. That's been the model in the past. Yeah. And following on that, you get a consumer base that wants to buy goods from around the world.
How does that show up in the pricing though? And it feels like when we've talked to shipping CEOs on this very show, they've said, look, even though the consumer story in the States may be slowing down a bit, we're not recessionary territory yet, the Chinese consumer is still growing and rebounding in a way that we didn't really expect, say, even 6 months ago. That's showing up in the shipping story, but where's the weakness there?
Well, what we're going to see is all of these transformations, all this investment that's going in is ultimately going to feed through into consumer prices and producer prices. The inflation story that we've been following, inflation is coming down in most major economies in the world, but there's only so much that they can fall now that all this investment has to go in. These green corridors that companies want to pay for to have their goods shipped around the world, those are not going to be free. There's going to be a surcharge for those. So ultimately, we're seeing inflation come down as it relates to shipping, but it's not going back to the pre-pandemic, rock bottom lows that we saw.
Yeah, certainly one thing that we're seeing kind of show up as also as a function of the manufacturing boom over in the States as well. Bloomberg's Brendan Murray, of course, with that story. We thank you so much for bringing that to our attention. A really fascinating one that connects, again, as Guy was mentioning, so much of the trade stories and the trade concerns in the next 6 months or so. We are seeing breaking headlines, though, across the Bloomberg terminal on a particular deal merger story. Brookfield seeks close to 10 billion euros of debt for the Grifols takeover. It's really moving the Spanish pharmaceutical stock to almost 6%. The context of the story is crucial. They're basically asking the banks to have a backstop for this deal, and it looks like it's basically just meaning that this takeover deal is being taken far more seriously and being taking the company private as well. So those shares higher by a whopping 6% on a very kind of quiet day, just moving the market.
Absolutely. Some single stocks are now moving.
Yeah.
So we're getting Danone. We've got Grifols on the move as well. Some idiosyncratic news in some single stocks that we're watching out for. Let's talk about a trend that we've been watching, though, for a little longer. Gold is in record-setting form. The precious metal is nearing a record high. Expectations are that the Fed is going to be cutting interest rates. That obviously helps gold because it doesn't generate interest. Joseph Cavatoni, market strategist for North America at the World Gold Council, joining us now to discuss this. Great to see you, Joseph. Thanks for stepping in and joining us. Look, gold's been on a really strong tear. People are buying it for a variety of reasons. Physical gold in particular has been very strong. But are we getting to the point now where the price is so high it's going to deter some more of that interest coming through? Are we going to be sort of capped out in terms of where we can go from here?
Well, good morning, and thanks for having me on. I think it's a really interesting time for gold, and I think that's a great question, and how we'd answer that would be simply to say you've got to understand the global dynamic of where the demand's going to come from and how that's going to continue to impact the price. over the first half of the year, what we've seen mostly has been Eastern investors, central banks pushing and driving the price. But as you've highlighted, the rate cut that's likely, the weakening of the dollar, the lowering of real rates, that's going to remove the headwinds that have kept the Western investor on the sidelines. So while we've seen that demand in the East, it looks like it could be slowing a bit, and the shift would be to the West. So to answer your question directly, we see a very good environment and a strong environment for the support of gold at these levels, and a likelihood that it'll continue to trend higher.
In terms of what is happening more broadly, the dollar is obviously coming down as part of that trend you've been talking about in terms of the rate narrative. Why are people buying gold right now? What do you think the main motivations are at the moment?
There's three factors that are keeping gold at the top of everyone's list, including central banks, which has been a big story for us for the last 2.5 to 3 years. It's actually a 14-year trend, but a 2.5, 3-year trend that's been very strong. So the first is that diversification benefit that you get from gold. I think the week of August 5th highlighted the fact that when you want the right kind of a diversifier in your portfolio, gold plays that role. So when risk assets are selling off, it holds its value as a store of value. Secondly, it adds that diversification in a way where the supply dynamic provides returns. And ultimately, it's a liquid instrument. And those three factors combined put it at the top of the list of a nice diversifying asset to a portfolio. If you think about where a reserve portfolio would look to add diversification against a weakening dollar or concerns around fiscal issues from the U.S. and the potential for issues around those assets, this type of asset that remains liquid and ready to be sold or obtained can actually add real diversification to your portfolio and strength to your portfolio. Risk-adjusted returns are favored by adding gold to a diversified portfolio.
Well, Joseph, expand on that story and the deficit story as well, because it's not just the states that is facing kind of that looming deadline when it comes to their fiscal budget in January. You're seeing it in France as soon as next month. You're seeing it, of course, in Germany as well. Some of the budget talks still a little bit icy there that we're trying to work through. How much demand does that create, though, for gold at a time when it's kind of largely expected that these are going to be looming issues? Is that really a catalyst that goes into the next 6-12 months?
So I think it's a great question. I think the way to approach this and to think about it is that it is a catalyst, but it's a slow-moving catalyst. What you're going to see as rate policies adjust and actually reset, and actually those factors weigh into the economy, you're going to see the Western investor move strategically to allocate to gold. We don't think it's going to be this shocking, quick movement on the gold price. We'll have volatility in gold, but what we won't have is rate cuts of 25 or 50 basis points in any of those markets, for example, have that much of a major impact on the gold price. It will be a strategic implementation that the Western investor will have as they diversify. So it ultimately is a global asset. I think you're highlighting Europe, which I think is a really interesting market. Over the last 6 months, what we've been seeing in terms of ETF flows there has been pretty substantial, over $3 billion of inflows into that market. So again, it's a quiet, slow movement of Western investors adding gold back into their portfolio.
Is it Western investors? I'm hearing a lot of Gulf asset managers buying. I'm hearing a lot of Gulf investors are buying as well. They are looking for a diversification trade. They're looking for a safety trade. What I'm not hearing, though, is the ETF trade. And it feels like that ETF trade has got a lot quieter. The expectation was that this would be the way that you traded gold. And if you wanted to buy that hedge in your portfolio, this would be the way that you do it. But a lot of people are turning to different and more physical sources. So why do you think that is?
Well, I think there's a few factors at play. Number one, the Western market has tended to like the ETF market, but remember, it's only 6% of the total investment market for gold. I think the level of comfort and confidence, and particularly in the Eastern investor to own physical gold, is actually a pretty well-known and a pretty common way for them to express their investment interests. I think you'll see the ETF flows come online. And again, over the last 3 months, what we've been seeing is a quiet, slow shift away from nothing but redemptions, not only in North America, but in Europe, and starting to see the flows back into the market. The ETF market in Asia has seen about a $3.5 billion inflow. But again, it's 6% of the market. The OTC market is the majority of where investment takes place. And large bars, kilo bars, bars and coins, those are common instruments that get used regularly. And I think that people have a confidence level of owning gold that way, and it's simple that they could make that investment happen.
Yeah, you got to have a big vault, and there certainly seems to be a lot of big businesses that are sort of building those vaults right now. Demand seems to be pretty high. It's an interesting way of playing that narrative as well. Joseph, thank you very much indeed for getting up early for us. We really appreciate it. Joseph Cavatori, Market Strategist for North America at the World Gold Council. We greatly appreciate it. Okay, what are we going to be talking about next? Traders, and this relates back to the gold story, waiting for rate cut clues. This after US markets end that 8-day streak. I'm talking about equities. We're going to take a look at what is likely to maybe get Europe out of what has been a slow start thus far. We'll do that next. This is Bloomberg.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
Welcome back to the opening trade. We're about 47 minutes into today's session. You're seeing green on the screen. Guy likes to say nothing's exciting. I disagree. I think there are a couple of individual stock stories that are very much exciting because you are seeing.
Yes.
Go ahead. No.
It's not on index level, but you got some single stocks.
On the index level, you are still seeing gains here, right? Higher by 0.2%. We didn't start off the session that way. It's marginal, but it's there. It exists. The individual movers, though, are far more exciting. Danone, for example, or Danone, as you say it in this part of the world, down about 1.3%. A big move in Grifols, the pharmaceutical provider in Spain, seeing some big moves off of the Brookfield story as well. So there's some excitement in these markets.
Yogurt is exciting this morning.
Yogurt and Spanish pharmaceuticals.
That's what a perfect combination. Natalia Likhvina joins us now around the table, head of EMEA Equity Strategy at JP Morgan Private Bank. Today's a little quiet, but let's park today and think about what happens next. We've just seen a huge bout of volatility, beginning of August. We've rallied really strongly off the back of that. The amplitude of the market is pretty big right now. Do we need to get used to that? Are we going to just continue to get used to kind of this level of volatility? I appreciate the VIX has come down, but can you see more big declines and more big rallies? Is that what we're in for over the next few months?
Yeah, good morning. When we look into the mid-2025, we still continue to be constructive on the equity markets.
Okay.
So we see around low to mid-single-digit upside on S&P. Now, what is really exciting is that in the last year, we really haven't seen a lot of volatility. And we started to see that at the beginning of this month. So we are very close to our target for the end of the year on S&P. So there may be more volatility coming into the market in the next couple of months. So if I'm thinking about long term, equities are still the place to be, but there may be more volatility to come.
Talk to us then about how people are viewing the tech space here. Is this a defensive trade? Is this a short squeeze trade or even a momentum trade? How do you classify what a bid into tech means?
We continue to recommend the technology sector. We think it's one of the most exciting sectors still, and especially on the recent pullback, there are loads of interesting opportunities that we can look into. Now, the next potential catalyst for the market is some of the tech stocks reporting. So we will try to understand what is happening with the AI trade, how the demand is shaping, if it still continues to be very strong, and also what that means for the hyperscalers, the companies that continue to spend a lot of money on AI. But broadly, yes, this is one of the sectors that is a very high conviction idea from us, either on artificial intelligence or cybersecurity.
So you're looking forward to NVIDIA next week, I guess. That'll be a big line in the sand. Before we get there, we've got to talk about the bond market. The payroll number obviously caused a lot of volatility. We're seeing some revisions a little bit later on today we're going to watch out for. Then we get to Powell a little bit later on this week. The market is anticipating, certainly the bond market, if you look at what's happening with the options, that we're going to see quite a big downside. There's quite a big bid coming into the bond market over the next few months. Which is going to do better? You're an equity person. Which is going to do better? Is it going to be the bond market or is it going to be the equity market? Or how finely balanced is it going to be? Is that a kind of critical decision in terms of my portfolio?
We still see low single-digit upside for the equity market by the mid-2025. We continue to step into the market. 60-40 portfolio looks attractive for us to start stepping into the market for bonds and equities right now. To me, what is really important as to what happened in the last couple of weeks is that the market got the confirmation of the soft landing.
Right.
If you look into the data, we got 3 different data points that show that soft landing is probably the base case. CPI data was just below 3% year-on-year. The market liked that. The weekly jobless claims were below expectations, meaning that the labor market continues to holding. And the retail sales, which was very much watched by the market to understand how consumers are doing, was also stronger than the market expected. So to us, all of that is a perfect illustration of how soft landing looks like.
So what do you want to hear from Powell on Friday? What are the magic words?
We're trying to understand the labor markets. It seems like the shift the focus is shifting from the inflation to how strong the economy has been. So for us, this has been the focus, and this is what the Fed said themselves last time, that the focus right now should be on the labor market. And that's why a lot of people in the market are trying to understand what happens with the consumers. Right?
Yep.
Yes, consumers are slowing down, but they're not falling. So that's why it's a completely normal to see a bit of a slowdown.
Is Powell going to shed any light on that, do you think?
I think it's just in general understanding how the economy is doing, right? In terms of if it's a slowing momentum and just trying to understand and link towards the cuts that we expect in September.
Okay. What about Europe? What's going on there? In Europe, inflation feels a little more sticky, growth feels a little bit more sluggish, but the markets are cheaper, and you've seen, obviously, a washout here as well. Is there a reason should I be diversifying out of the United States into Europe? Should I be going the other direction? How should I be thinking about the European equity trade right now?
So the Euro Stoxx 50 has been outperforming US at the beginning of the year.
Yep.
And we started to see that trade stalling.
It's definitely faded. Yep.
It's faded in summer. We have adjusted our numbers. We no longer expect Europe to outperform the US. What we're seeing right now is that the economic momentum is a bit weaker in Europe, and also there are a bit of negative earnings revisions coming off Europe. Now, having said that, there are lots of opportunities underneath the surface in different sectors. So those will be the multinational companies that we continue to have conviction on in technology sectors, in industrial sector, in luxuries. So a lot to do underneath the market, but broad-based, we expect the US to do better than Europe.
All right, Natalia Lipina, we will leave it there. Head of EMEA Equity Strategy over at JP Morgan's Private Bank. We thank you so much. Kind of trying to make sense of what these equity markets are doing. So even though maybe not a ton going on the index level, there are still things going on underneath the hood. I want to get a quick check on shares of the Spanish pharmaceutical company Grifols as well. It is continuing to move higher by about 3%, now pairing that initial gain of over almost 6% that we had seen. It comes after Brookfield talks about seeking to close a 10 billion euro debt deal for the private takeover. Remember, this comes after Grifols was dealing with a short seller attack, their stocks, their bonds, a massive restructuring. Now it looks like Brookfield Asset Management is coming into that.
Let's talk about yogurts. Danone under a little bit of pressure this morning. This on news that China is launching an anti-subsidy probe into dairy imports from the European Union, adding it to its targets in the bloc's agricultural industry. Ollie Crook's back. Let's talk about this. Ollie, we were talking about what Europe did yesterday on the car front. Yogurt seems to be the response.
Yeah, yogurt seems to be a response for the moment, and obviously this is going to be very closely watched in terms of where they decide to dial up this pressure on the European market here. I mean, they've talked about doing things on pork. They've talked about doing things on spirits. We've always seen this across the French market, whether it's these sort of alcohol makers, the luxury trade, but also cars, right, Guy? Because it's not just the imports of EVs, it's the exports of those super expensive, valuable, large engine cars that they make here in Europe that go over to China. Those are really, really important. When you look at the sort of trade breakdown between China and the EU, you look at what the EU exports the most over into China. Number one on that is motor cars and motor vehicles, but we should say that has been a historically very large number. That has been falling in recent years. Number two is medications. Then there's other machinery and other motor vehicle parts. Those are the major sort of exports from the EU into China. When you look at the actual trade balance in terms of the only categories in which Europe runs a trade surplus with China, that is only in food and drink, it's in raw materials, and it used to be, it no longer is, basically since the invasion of Ukraine, chemicals and energy. So these are all the sectors that could be hit. It's interesting, though, Guy, that they decided to hit agriculture and they decided to hit dairy because, as we know, there are huge volumes of subsidies that come from the EU into the farming sector and all across the agricultural sector. So it'll be very interesting to see where this goes. But, of course, the massive sort of trade surplus is in China's favor, so any sort of pain will be felt probably more by China than it possibly ever could by the Europeans.
All right, Bloomberg's Oliver Crook giving us a lay of the land of what what the repercussions of this battle actually looks like. We thank you so much. It is pretty fascinating that we're seeing such a painful reaction in Danone shares this morning, down about 2%. But I'm curious, as Ollie pointed out, when the rest of the market is going to start to price more of this in.
You've got to assume that there are going to be other sectors. It's something that affects the luxury sector, potentially further down the road. He talks about the kind of the high-end car sector. That certainly looks like it's at risk in all of this. And it's interesting that agriculture, as Ollie points out, it's an area that's been historically heavily subsidized by Europe.
Yeah.
So maybe that kind of adds some sort of symmetry to what is going on there. We'll see. It's certainly an evolving story, and it looks like it's beginning to evolve a little bit faster.
Yeah, it's almost starting to take on kind of the trade war that we saw with the States as well, which, and again, in 6 months' time, if that revamps even more, we're going to perhaps see more global pain, more synchronized pain. So that is the story for today. We are seeing markets that are still green on the screen when you look at the equity markets, light volume, light liquidity, but green on the screen nonetheless. That does it for the opening trade. The Pulse is up next. A conversation with Zealand Pharma CEO coming at 9:15 a.m. Stick with us. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
European stocks brush off declines in Asia as investors wait for an annual review of key U.S. jobs data and the Fed minutes for further clues on rate cuts. JD.com and other Chinese tech stocks fall after Walmart sells its stake in the e-commerce giant, raising about $3.6 billion and closing an 8-year partnership. Plus, Barack Obama and Michelle Obama deliver blistering critiques of Donald Trump at the second night of the Democratic National Convention as nominee Kamala Harris looks to recapture the same political momentum from 2008. So we do have quite a lot of politics news, but we look at the markets. We had a bit of a sell-off, actually, in Asia. Now, stocks today, actually, in Europe are drifting. Again, investors not only looking at U.S. data, but they really want to see what Jay Powell has to say from Jackson Hole on a Friday. Now, there is, of course, the annual review of U.S. jobs as this meeting, of course, minutes from the Fed. But there is also big positioning on dollar, and there's certainly a big positioning that the market thinks that we will see a September cut from the Fed. If that doesn't happen, then watch out for volatility or things could go all over the place. So the U.S. 10-year yield, 3.8180. You can see S&P futures practically unchanged. We look at the unwinding, the possible unwinding further of the carry trade. Remember, there was a big unwinding 2 weeks ago, then it was put back on and now down. And then, of course, our biggest story of the day is what's happening in the U.S. with retail. Walmart and JD.com, 102.1. It was down 9% in Hong Kong. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. Happy Wednesday. I'm Francine Lacqua here in London. So traders will definitely scour the July Fed minutes today for hints on the end of QT in a meeting that took place days before the week jobs reports. Well, an annual review of U.S. jobs data is also due today. Let's get straight to our markets analyst, Maria Monichi, fund manager at M&G Investments. Maria, as always, thank you so much for joining us. What a week. We have Jay Powell. We're waiting what he has to say on Friday, and then we have all of this data looking at the minutes. Do you think that the markets are far ahead? They're expecting too many cuts, or they're too certain that we'll get a cut in September?
Well, it's certainly a very busy week and what has been already a very busy month around rates and rate expectations. And I think, there is a lot of focus on trying to understand not only where the Fed position is around the labor market, but where the labor market actually is today. And I think there is a lot of focus on single data, but unfortunately, when we look at the labor market, we have to have a broader picture of what are the different indicators that can tell us the full story. So what we're seeing so far is that there's certainly be a level of normalization in the job market, but there is some new dynamics that are following the pandemics that needs to be taken into account. And I think potentially what the market might look at into the Fed minutes and into Powell's speech later this week is really a little bit more of insight on what are they looking for within the labor market, what are the trends that they're observing at the moment, and that we will continue to follow, which will then dictate what the policy will be in terms of interest rates.
Maria, I feel like the market, again, was, going for a soft landing, and then there were worries about a recession, and now a lot of the big banks has gone back to this Goldilocks scenario. Again, is that too optimistic?
Well, I agree that we're back in a central scenario of soft lending, and there's been a very, very short period of time at the beginning of August in which we've entered a heightened risk of recession, and the talk about emergency cuts even before the September meeting, and that's very, very quickly been dissipated, and we've seen how equity markets have rebounded on the back of that. I think the way the curve has shifted in the US is very, very interesting. So obviously we had the short end of the curve starting to move much lower in terms of yields and pricing in quite significant amounts of cuts. I think at the moment, we've lightened up the position on the shorter end of the curve in the US. There is a little bit of vulnerability in the sense of, what will actually happen in terms of rate cuts in the coming months. But if we move further along the curve, so if we look at 10, but also in particular if we look at the 30 years, I think we're still at levels which are quite interesting, still just above the 4% yield mark, and also a curve that has been steepening in this latest phase, so that gives a little bit more of potential, again, on the longer end of that curve. And the other element that has been extremely interesting to observe has been, this renewed correlation and these diversification properties of the U.S. Treasuries in general in the long end in this risk-off phase. And that from a multi-asset investment perspective has been extremely interesting to observe and, hopefully an interesting indicator of, what can we expect from here in different risk-off scenarios.
So what can we expect? Again, gold's moving, and I don't know how difficult. I mean, it feels impossible to actually see where we are in the unwinding of this carry trade. Will a lot depend on what BOJ does on where you put your money in terms of risk assets?
Yeah, extremely difficult and very opaque to understand exactly, the amount of money still present in the carry trade and how will this continue to unwind. Certainly the dichotomy on the direction of the two central banks have been, quite an important pivot in this phase. But the extent to which this will continue to unwind is very difficult to predict. Certainly there is still a very important interest rate differential, so there is, still benefit of maintaining the carry trade for some players in the market. But at the same time, potentially from a more fundamental standpoint over the longer term, you can see the two currencies moving, again, in opposite direction from what we've seen in the last couple of years. So I think what is interesting is what the implications might be from the equity market perspective in Japan. And what we've observed at the beginning of August was, in our view, very much an overreaction to the potential unwinding of this carry trade. We've seen, enormous volatility on the Japanese equity market, with pretty much no change from a fundamental perspective. Yes, a slight different direction from a policy standpoint, but nothing groundbreaking in that regard, and even in terms of the sizing of the moves on interest rates. And so I think in this phase that has represented an interesting opportunity from a tactical standpoint to enter into Japanese equity markets as well as Korean equity markets, which have also sold off significantly together with Japan. And we've seen already quite a significant rebound in these markets, after this very strong volatility of the beginning of August reversed.
Maria, are you constructive on anything in Europe if you look at UK assets or European assets? Again, they're caught. I mean, we're also getting some possible retaliation on dairy products from China, and so Europe seems to be stuck in the middle.
Yeah, so I think Europe continues to be very attractive from a valuation standpoint compared to other equity markets. So in a medium to longer term sense, I think there is value there. There are companies that are very global in nature and that have exposure to very interesting sectors that could also do well on a cutting rate type of environment. So there is opportunity there for the medium to long term, especially in an environment of soft landing where you can continue to have this grinding growth on the background in a context of declining rates, which we've already started to see in Europe, and where the current inflation backdrop really is continuing to be supportive for that to continue. It could always reverse, but the trends that we've been seeing on inflation data, it's been pretty robust so far and really moving towards normalization.
I imagine many clients are saying, like, what do I do with gold, but also do I go to cash?
Yes, I think cash in terms of the real yield that is offering still remains quite attractive. Especially if you compare that with some pockets of the equity market that might have moved quite excessively. I probably wouldn't have said this just a week ago when we were just after the sell-off, but things have moved really fast. And there are pockets of the equity market that might look a little bit vulnerable, if not so much on a valuation standpoint, but also because this valuation is relying very much on very strong earnings. And if you have some faltering on the earnings delivery, then you might have some disappointment on some areas of the market. So in this regard, cash in a diversified portfolio still remains quite an interesting asset to play with. However, if you start seeing the correlation across equities and fixed income playing out a little bit more, so for example, sovereign debt regaining this role of diversifying assets, then cash becomes all of a sudden a bit less appealing. But obviously, this will be more robust in an environment of declining interest rates. And volatility is likely to still be there, as we have seen for the last few years on fixed income markets.
Yeah, and hopefully we'll have a little bit more of a glimpse into these declining interest rates at the end of the week with that Jay Powell speech. Maria, as always, thank you so much for joining us. That was Maria Munichi, fund manager. I can't speak, it's Wednesday. Fund manager at M&G Investments. Coming up, the obesity market has seen a massive boom in recent years. We'll be speaking to the chief executive of Zealand Pharma to find out what's behind the recent rise. That's next. And this is Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Welcome back, everyone. Now, the obesity market has seen a bit of a boom in recent years, and Goldman Sachs actually predicts it will be worth $130 billion by the end of this decade. Well, one company looking to take advantage is Zealand Pharma. The Danish firm is currently the best-performing stock on Eurostoxx 600 year-to-date, with its share price rising to some 250% over 12 months. Well, I'm delighted to be joined by Adam Steensberg. He is the chief executive of Zealand Pharma, and he joins us now for an exclusive conversation. Welcome to London. Welcome to the Pulse. Thank you so much for joining us, Adam. I mean, it's pretty incredible when you look at the stock price. It's been an incredible run since the beginning of the year. What do you think has happened to your company to attract all of this attention?
I think there's no question. There's just a strong and very deep recognition that we have one of the most exciting obesity pipelines across the industry, and therefore also have a potential to become a key player in this growing market in the future.
So how far along are you in actually developing an obesity product that you will sell to consumers?
So we actually have, you can say, 4 products in development, and the one we are most excited about is a novel kind of molecule called petrelintide, which could be, if everything goes well, on the market in 2029.
And again, what kind of, I mean, this revolutionizes, right, the way that we look at obesity, because it lead to, do you know, do you have any forecast of the kind of market cap that could give you?
No, I mean, I don't speculate on that, but I would say we are extremely ambitious with the company. We think with petrelintide, and this, in particular with petrelintide, we really have the potential now to develop the first true alternative to the current, you can say, molecules that are being rolled out to patients. So, and with the profile that we have seen thus far, we also think it could form a future backbone in the management of obesity. So we are extremely ambitious on behalf of Zealand and the journey that we have in front of us now.
So how different is this molecule to what we have at the moment?
You know, I think if you look across both the first 2 molecules that have been approved and are being rolled out to patients today, and also a lot of the pipeline programs, most of them are built on a molecule called GLP-1, so leveraging the biology of that. We are leveraging the biology of a molecule called amylin, and you know, it works in a different way, where the GLP-1 class mostly work by reducing your appetite. Amylin works by introducing satiety. So those are 2 very different experiences. And I would also say the early clinical data that we have suggests that we have less side effects. So a lot of patients who get exposed to GLP-1 have nausea, vomiting. We don't see the same degree of nausea and vomiting with our molecule so far.
So if you're expecting this drug to actually be available, well, one of the 4 that you have in the pipeline by 2029, how big will the market be by then?
You know, it's so difficult to predict how big the market will be. I think what we have to recognize is that obesity and the obesity pandemic is probably the biggest healthcare challenge of our time. And therefore, you can say it also will be the biggest market for medicines in the future. So I think still most people underestimate how big it will become. And in our books, there will be many more patients on treatment than what most people expect, because it's not about obesity, it's about the consequences of living with obesity for a long time. So we think the market will be very, very large, because we have to address this, otherwise we'll have too much chronic diseases.
I mean, you're really seen as, you know, the potential big competitor to Novo Nordisk. Again, what would you say in terms of differences and what that means also in your country?
You know, both Novo Nordisk and Lilly, having launched the first, I can say, once-weekly product that can truly address the weight loss that people are looking for, they are focusing with the current rollout on creating this market. What we are focusing on is the next innovation, the wave, the medicines that could make a difference in the 30s.
So you must be a takeover target.
I don't think, I mean, that's not our strategy, at least. Our strategy is to continue to develop these medicines alongside a partner. So we will be out looking for the right partner who can help us get these patients through development and into, you can say, a broad use if approved. But, yeah.
Have you found a partner? Are you in talks to find a partner? And what kind of partner are you looking for?
Yeah, so we had some fantastic data readouts in June of this year, and we have been very kind of, you can say, open around the fact that after these days, and also following a quite significant capital raise in June, we will be initiating partner discussions in this second half. And what we would be looking for is a large pharma company who will be as committed and have the same vision and ambition around petrelintide as we have, somebody we can work alongside in a co-development and co-commercialization partnership.
Does it matter if they're based in Europe? Would that make a difference compared to someone in the US or elsewhere?
No, I mean, for us, the interactions we will have will be with some of the largest pharma companies of this world. The most important thing is they have a global reach and they would share our vision and ambition for petrelintide.
With the two big, companies that are doing some of these obesity drugs at the moment, Novo and Eli Lilly, have struggled with capacity. Do you think that continues?
This will continue for some years, but I'm also very sure that when we approach the 30s, I mean, there will not be a capacity problem anymore. This is about investing in time. It takes time to build capacity, so you can say as long as you start to invest in time, there will be no capacity problems in the 30s, in my mind.
But so what happens to now until the 30s? I guess the concern is that, we have 6 years of maybe uncertainty.
Yeah, but I mean, I think everybody recognizes today that it's a supply-driven market today because there's shortage on drugs and manufacturing capacity, and that will remain an issue for some time, and that you can say, but the good news for Zealand is once we are ready to launch our medicines, I truly believe we will solve these issues.
I mean, pricing is a huge issue at the moment. Will yours be cheaper?
I mean, again, it's too early to comment on those things, but I can just reiterate that obesity is the biggest healthcare challenge that we are facing. So many more patients will have to be on treatment. We will also have to do other things in society to drive down the obesity pandemic. Ultimately, when you see volumes going up, I would also expect prices to go down.
Thank you so much for joining us today for a very, very interesting conversation. That was Adam Seensberg, the Chief Executive of Zealand Pharma. I have a feeling we'll hear about Zealand a lot more in the coming months and years. Coming up, we talk politics. Barack Obama headlines the second night of the Democratic National Convention as Kamala Harris leans on his campaign in the race for the White House. We have the full details next, and this is Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
do not need 4 more years of bluster and bumbling and chaos. We all know that the sequel is usually worse. America's ready for a better story. We are ready for a President Kamala Harris.
Barack Obama there headlining the second night of the Democratic National Convention in Chicago. Now, for more on this, let's bring in Bloomberg's Vonnie Quinn, who's in D.C. for us. Vonnie, interesting, really interesting. This is something that you pointed out, to see Harris bringing in veterans from the Obama White House and campaign. How much has the electorate actually changed in 16 years?
Well, the dynamics that were already happening when Barack Obama got first elected have just continued to happen, right? The whole of America is changing. It's getting more multicultural. It's getting more diverse religiously. It's changing in states as well. You know, state to state, we're seeing various dynamics happen. But what this team that got the first person of color elected to the White House will want to do is repeat that, right? So you're seeing David Plouffe get put on the Kamala Harris payroll. He ran the 2008 campaign. Also, Jennifer Palmieri, who is the communications director. These are names that we know very well, right? Because they were around D.C. for 8 years during the Obama presidency. What they will want to do is get that Obama coalition back, right? So particularly a reach out to black voters. Turnout among black voters has been decreasing. And while the actual proportion of registered black voters in the Democratic Party itself hasn't changed too much over the years, turnout has. They will want to reach out to those voters. Also, what Barack Obama did very well in 2008 was appeal to northern white voters, particularly uneducated voters. Kamala Harris will be looking to get that proportion of the population back as well. They overwhelmingly flipped to Donald Trump in 2016. So this is the coalition that this group of staffers that are now in the Harris campaign will be targeting very specifically. Those and, of course, suburban women and independent voters. But just to put a few figures on it, the Hispanic vote has more than tripled in the last 30 years, right? So now we're talking about 16% of registered Democrats are Hispanic. And then you also have the Asian vote as well. She's South Asian. She would be the first Asian in the Oval Office were she to be elected. That represents about 6% of the potential Democratic vote in terms of registered voters already.
Vonnie, is there a danger that actually Democrats become too complacent, especially at a time when the Trump campaign are now trying to brand themselves as the common sense option?
Exactly, trying to almost counteract the weird moniker that's been traveling around Democratic circles. There is, I think, Francine, and you saw that tonight, you saw Michelle Obama and Barack Obama really press home this idea that this is not going to be an easy election to win, and that they need to constantly and, you know, considerably make an effort between now and Election Day to get out that vote. I'll just quote for you Michelle Obama: "This is going to be an uphill battle. We need to vote in numbers that erase any doubt. We need to overwhelm any effort to suppress us." You're going to see this. Kamala Harris has said this as well.
Vonnie, thank you so much. Of course, looking at that very closely from Washington, D.C. live, Vonnie Quinn there. Coming up, as Mpox spreads in Africa, the focus turns to securing enough vaccines on the continent to stop the outbreak. We'll be speaking to the Director General of the ECDC. This is Bloomberg.
Principles, our policies in support of
the Palestinian people will never change. Our policy in having a two-state solution will never change, and nothing will compromise it. And as long as we are, having the capability to be helpful, we will do it. We did that between Afghanistan, between Taliban and the US. We did that between different parties in Lebanon and Sudan and others. And that's basically the core of our foreign policy. It's been built based on mediation, on trying to help in resolving conflicts between the party. There are countries or people might not like it, but we don't ask everyone to like it, just to understand it.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning, everyone, and welcome to The Pulse. I'm Francie Lacqua here in London. These are your top stories. European stocks brush off declines in Asia as investors wait for an annual review of key U.S. jobs data and the Fed minutes for further clues on rate cuts. JD.com and other Chinese tech stocks fall after Walmart sells its stake in the e-commerce giant, raising about $3.6 billion and closing an 8-year partnership. Plus, Barack and Michelle Obama deliver blistering critiques of Donald Trump at the second night of the Democratic National Convention as nominee Kamala Harris looks to recapture the same political momentum from 2008. Now, on to Mpox vaccines, and they're expected to arrive in Africa by the end of next week as a new strain spreads from the Democratic Republic of Congo. The Director General of Africa's CDC says stopping the continent's outbreak will save lives in the rest of the world.
The response we are talking about is led at national level by the minister, at regional level by the regional economic communities, and at continental level by Africa CDC, working with all partners.
Well, Bloomberg's Chief Africa Correspondent Jennifer Zabazaja joins us now. Jen, what more did we actually learn from authorities on Tuesday?
Well, Fran, authorities were really trying to use Tuesday to dispel any sort of concerns that have been surrounding Mpox since it was declared a global health emergency. I mean, if we start with the WHO, we did hear an official say that, no, this new strain or the old strain, no, it is not the new COVID. But then just there you were hearing from the Africa CDC director who talked about the importance of not making the same mistakes that we did see with the COVID pandemic. And, of course, ensuring that Africans get vaccinated in order to support the fight against this disease more globally. And in particular, he did want to address and actually educate people about the response to this disease, which I thought was quite interesting. He said, I clearly request our partners to stop thinking about travel bans against Africa. That will bring us back to the unfair treatment from the COVID period and will not help the world move forward. So really a lot from authorities trying to get people on the same page about this.
Jen, do we have any indication about which vaccine manufacturers will be providing these doses?
Well, we've heard a bit from a number of vaccine manufacturers, Fran. We heard from Roche, which said that they did want to update their laboratories to, in fact, help with Embark's testing capabilities. We also heard from Emergent, which has a smallpox vaccine, saying that they would be willing to donate their doses to the DRC. South Africa also has BioVac, which has also discussed plans. But maybe in particular, Bavarian Nordic has been speaking, from our understanding, with the Africa CDC. And they're the only ones, or one of the only ones, that have an approved Mpox vaccine that could potentially fill the gap that is needed. But what's important to remember is that it's different to express interest and then to distribute. And also we have to think about the cost. And so a lot of authorities have been talking about just how expensive some of these vaccines are. And a lot of these are going to go to low and middle income countries. And so there might need to be some subsidizing happening. But not just that, there also potentially needs to be some insight into how logistically we're able to get people vaccinated. And so, you know, as you were mentioning, we did hear from the Africa CDC saying that potentially next week we will see vaccinations starting in the DRC, but waiting to hear really the other manufacturers about how they're going to themselves step up and also support in their own ways.
Jen, thank you so much. Bloomberg's Chief Africa Correspondent, Jennifer Zabazaja. Now let's also speak to Pamela Rendi-Wagner, Director General of the European Centre for Disease Prevention and Control. Pamela, thank you for joining us. I mean, there's still a lot that has to emerge for us to really understand some of the epidemiology and the best way to deal with this. But what does the ECDC actually do at the moment to understand also these new variations, for example, of Clade 1b?
Well, we are constantly, for the past months, monitoring the situation, of course, in Europe, but also beyond. We are in constant coordination and contact with the other CDCs, like in Africa CDC, but also with the United States, in order to have a global picture and a big picture of the developments. But what we can see is a rapid increase of cases in Africa, with a rapid spreading to other countries. So all in all, it's a very unstable and blurred picture right now in Africa. But what we can expect and must expect actually is more sporadic imported cases to the European continent. So we have to be aware of that. We have to be prepared. The member states, the surveillance systems, the medical facilities have to be prepared. But final sentence to this, it's not the new COVID.
So this is something that I was going to ask you about. Again, when people see a lot of the headlines, they kind of worry that we'll get into something like COVID. Do we have any understanding, Director General, on how these new strains are developed? And are the next 3 to 4 weeks with the first vaccines arriving in the African continent crucial?
Well, from the scientific point of view, I have to tell you that there are many open questions, many unknowns at the moment. And the big thing now for the experts globally is to fill these gaps of knowledge in order to give more precise answers with regard to recommendations, precautionary. This is of utmost importance from the scientific point of view. That's why we are in contact with the member states, of course, with the experts, but also globally in Asia and United States, but most importantly with the African public health authorities, where we have experts also on the ground in Kinshasa.
Yeah, so we also have a number, of course, of reporters I've been following very closely, and they keep on telling me that I guess the big question is also, you know, to what extent can we draw from the knowledge of previous strains of Mpox in how we should respond to this new strain? I mean, how difficult, A, is it to get the answers, and when can we expect to have some answers on that?
Well, it's a very important point you're raising, because Europe and globally, we have experience with Mpox, because we had an outbreak 2022. It was another clade. It was the clade 2. So up to now, we don't know the precise differences between the current upcoming clade, which is clade 1, compared to clade 2. We don't know really what is the difference, but there is experience, at least for the European member states. I can say that there are surveillance facilities in place. They are monitoring the situation. there are contact tracing facilities, testing and diagnostics in place. And this is most important in order to respond as quickly as possible if there is a sporadic case, in order to avoid a further spreading at the European continent outside Africa.
Is it starting to spread before patients actually show symptoms?
What I can say, we have been, as ECDC, we have been done a new updated risk assessment. And I want to mention that the risk for the European population, the general European population, is low. And this is very important, a very important message for the European people. But what we also know that there are risk groups, people going to the affected African countries, having close contacts to the African communities, including sexual contacts, they have a moderate risk, so they have a higher risk. And if they have an underlying disease, like immunocompromised people, they have even a high risk. So we have to really raise the awareness for this risk among travelers, and also advise people returning from these countries with suspect symptoms to go as quickly as possible to a healthcare facility to test in order to avoid further spreading and avoid any people.
Are children more at risk?
Well, this is one of the most important questions we would like to have answered very, very quickly. According to the African data from Africa CDC, we see that the majority of cases are kids below the age of 15. So indeed, it seems to be that this virus is spreading also among the youngest age groups. So we have to be aware of that. If this is also true for a situation in Europe or outside Africa, this is not possible to be answered yet.
Thank you so much for joining us. That was, of course, a very important conversation with Pamela Rendi-Wagner, Director General of the European Centre for Disease Prevention and Control. Coming up, retail results in full swing with Macy's, Target's, and TJX all due to report today. The question is, are U.S. shoppers still spending? We'll discuss that next, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
DOJ or other authorities
could face bigger challenges next.
Was going to keep Green World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. This week, Balance of Power is live in Chicago for the Democratic National Convention.
So we've got a race here, and the sprint begins.
We'll bring you breaking developments.
Vice President Kamala Harris closing the gap with Donald Trump.
And informative analysis, all leading up to special coverage Thursday evening, including Vice President Harris's acceptance speech as the Democratic nominee for president.
As president, I will show Donald Trump what real leadership looks like.
Tune in all week on Bloomberg Television.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. So don't bet against the U.S. consumer. That, at least, was a conclusion that many drew from last week's retail sales data. But as earnings season continues, we're getting a clearer picture of the health of the American shopper. Now let's bring in Bloomberg's Dasha Afanasieva. Dasha, so you're, of course, a retail expert looking at all of these earnings. There's a bunch of companies in the U.S. reporting. What are traders looking out for?
So they're looking for the strength of the U.S. consumer and what is it that people are willing to spend on and not. And so far what we've seen is they're definitely not spending on DIY and they're definitely not spending on these big ticket items, but they perhaps are looking for good deals. So that's why Walmart actually improved its outlook. It's all about bargain hunting and promotional activity. I think the other thing that's key when so many retailers and consumer companies are struggling to grow the top line is what are they doing on the bottom line. So I think it's very important to to have clarity about productivity savings, about headcount reduction, which is obviously a really sensitive subject. So I think profitability in that environment is in focus.
I mean, at the moment, the market is just trying to get any clues on, the health of the U.S. consumer because they worry about a recession, a Goldilocks scenario, or a soft landing. What are the big retailers in the U.S. that we should be watching out for to really give us an indication of bargain shopping and whether that translates into the economy?
So TJ Maxx is reporting later today. We've already had Walmart. Their Sam's Club sub-brand is doing really, really well. And they're talking about consumers doing bargain hunting. Beyond that, I guess the Macy's is also reporting today, which I think that's a different environment. That's not really about the bargain hunting.
Dasha, I mean, the other big story is, of course, Walmart. It's one of our most read stories. So it sold its stake in the Chinese firm JD.com. What does it tell us about, I guess, their strategy in China?
So Walmart's actually doing really well in China despite the Chinese slowdown and weak consumer sentiment, and that's because their Sam's Club brand, which is hypermarkets, but that operate on a membership basis, which means that people think they're getting this amazing deals. And it's doing really well. They said they had double-digit growth. So it shows that they're pivoting away from this kind of third-party investment, because also JD.com is really fierce online retail competition with the likes of Alibaba and Temu, and they're kind of saying, well, we don't, that it looks like that investment hasn't really panned out as well as you'd hoped. It goes back all the way to 2016. And then the IPO of JD.com came later and is trading down on that, I think largely because of the state of the Chinese consumer. So, playing in China, I guess it's important to have these focused businesses when sentiment is so poor.
So interesting. Dasha, thank you so much for joining us. That was Dasha Afanasieva with the very latest on retail in the U.S. Now, China has launched an anti-subsidy probe on dairy imports from the European Union. It comes after the EU launched additional tariffs on electric cars shipped from Beijing. Well, for more, let's bring in Bloomberg's Oliver Crook in Berlin. Ollie, they're going after the cheese. They're going after the yogurt. How important is this for the rest of the world?
Yeah, I know, Francine, this hurts you as much as it hurts me. Cheese both fresh and processed that are being hit by the Chinese now in retaliation to what we saw out of the EU. And really, this is sort of the opening salvo. I should say the second salvo, because they've already opened some investigations into pork. But the question is, what else would they be able to look into, right? Because so these are the two sort of interesting sectors. It's interesting they choose agriculture, Francine, because we know how heavily subsidized the agricultural sector is across Europe and in many countries across the world. So maybe that's sort of seen as low-hanging fruit for them. But we've talked talked also about spirits, obviously luxury goods. The French are very sort of keen on that, and it's very important to them. But also cars, because we're focused on the EVs coming from China. The Europeans sell some of their highest margin, most expensive big engine ICEs into the Chinese markets from the European market. So that is something that they could target, and it's something that they would hurt the Europeans. If you look at actually the biggest exports to China from Europe, number 1 is cars, number 2 is medications, and number 3 is machinery. So these are all places that they could turn up the pressure. When you look at the actual only categories in which Europe runs a trade surplus with China, it's raw materials and it's food and drink. So these are the things that we really need to pay close attention to. But as we know, Francine, the overall trade balance is really tilted in favor of China. So there's only so much damage they can do without having the Europeans then ratchet it up again and then get a full-blown trade war, which really would hurt China substantially.
That's in direct response, Ollie, to the EU's move yesterday on the EVs. So what's the latest twist there?
Yeah, so we got the latest sort of figures from the EU. They revised some of the tariff figures on each of the individual car makers. I'll give you a sample of some of them to give you an idea of how big they are. So for example, SAIC has got a 36% tariff. That's really at the top end of the range of these sort of cars that are built in China and shipped into the EU, and the tariffs they'll pay. Geely, which owns Volvo, is up at 19%. BYD, which is really critical, Francine, as we know, because it's the sort of biggest competitor, the biggest player in the EV space, down at 17%, which is high, but really low given the ranges here. And then Tesla at 9% there, because the EU says that basically a lot of these foreign companies that build cars in China and ship them over to Europe actually get a lot fewer subsidies. The Chinese have pushed back against this aggressively, saying that they're strongly dissatisfied and they're firm opposition, and that the reason that their cars are so cheap is because they just have better supply chains and they do business better. So this is going to continue to rumble on until October 30th, when these sort of tariffs are finalized and will last for 5 years.
All the earnings out from some key Chinese car companies, how does that fit in?
Yeah, so really interestingly, we had the numbers out of Geely just a few hours ago, and they posted really a record profit. They've got really a lot of growth going in terms of their vehicle deliveries, up 41%. It's really interesting because though the Chinese market is slowing down domestically, we've talked a lot about this on Bloomberg, what they're seeing is a lot of export growth. But with a 19% tariff, as Geely is looking at, this could really hit their sort of growth going forward, though they did feel confident enough to revise their expectations higher. You had a very different story over at Xiaopeng in the EV space. That's a pure EV play company. Those earnings came really, really much lower. What I think is interesting when we talk about the EV market, Francine, is that we look at some of the research out here. Just 19 of the 140 EV companies that exist in China are expected to be profitable by the end of this decade. So with this tariff sort of conversation really amping up the pressure, I think we're going to see a lot more consolidation and failures within that sector. So it's going to be something we're going to be watching very closely over the coming months.
Ollie, thanks so much. Oliver Crook there with the very latest on China versus U.S. versus Europe. Now, coming up, we'll have plenty more, of course, on today's top stories, but also the search for missing passengers continues off the coast of Sicily. Among them, the tech entrepreneur Mike Lynch. We'll have an update for you next. This is Bloomberg.
Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
In Italy, rescue divers are preparing for a third day in their search and rescue efforts around a sunken yacht off Sicily, where British tech entrepreneur Mike Lynch and Morgan Stanley's Jonathan Bloomer are among those feared dead. Let's bring in Bloomberg's Olivia Solon. Olivia, what's the latest on the search for the missing people?
Right, well, a third day of searching is underway, and there are divers in the water still trying to get into the Bayesian yacht. As far as we're aware, none of the 6 missing people have been found yet. They're believed to be inside the yacht, and authorities at this point are saying that they are unlikely to find any survivors. It's been very difficult to get into the yacht because of so much loose furniture and debris blocking the entry points. And because the vessel is currently about 50 meters underwater, that's quite deep for the divers, and they can only spend small stretches of time working on the yacht before they need to come back up to the surface.
Olivia, do we have a better sense of why the yacht sank?
So there are a lot of questions remaining about this. It's a huge, huge yacht, and it sank within minutes, according to various eyewitnesses we've spoken to. The yacht did have this very large mast. It was this kind of unusual sailing yacht. And the mast itself may have caught the wind, which would have shifted the vessel off balance. But that does not explain why it took on so much water and sank so quickly. I think one of the biggest questions at the moment is whether any of the hatches on the vessel might have been open, which would have allowed the water to enter the vessel and cause it to sink so quickly.
Olivia, Mike Lynch, we understand his family were celebrating his recent acquittal from fraud charges. What do we know about who else was on the boat?
He had a bunch of, it was family and friends and some of his legal team. His 18-year-old daughter, Hannah, was there, his wife, who was rescued. There was his lawyer who involved in his fraud case, Chris Morvillo, and his wife, Nada, as well as Morgan Stanley International Bank Chairman Jonathan Bloomer and his wife, Judy. Those are the people who remain missing at the moment.
Olivia, thank you so much for the update. We'll have plenty more, of course, on this throughout the day with Olivia, and we'll bring you any breaking news as soon as we have it. Now, this is what else we're watching for today. We do have some U.S. retail earnings. We have Macy's, we have Target and TJX. Then we're hearing from the ECB's Panetta. He's the governor of Banca d'Italia. He's speaking at an event a little bit later. And then a couple of other things. Of course, the big one is not only the Fed minutes at 7 p.m. UK time, but then we go back to the Democratic National Convention with the acceptance speech from Tim Walz. Now, stocks drifting, investors again awaiting this annual review of U.S. jobs data, but also Federal Reserve minutes for further clues on interest rate cuts. So we'll look at the market moves. We'll have all of the very latest on the data with Danny Berggren, Manus Cranny, and Bloomberg Brief. That's next, and this is Bloomberg.
biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? Is it just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Good morning from our global headquarters in New York City. I'm Danny Berger. Manus Cranny is out today. Welcome to Bloomberg Brief. Let's set your agenda. An 8-day rally halted. Stocks are now steady ahead of Fed minutes and revisions to jobs data. Walmart drops JD.com. Shares of the Chinese tech giant sink after Walmart sells its $3.6 billion stake. And the Obamas rally voters at the DNC, praising VP Harris and ripping into Trump. Will the 8 days of a rally come to a stop? We're going a whole lot of nowhere this morning. Unchanged on your S&P 500 future session. The next catalyst, 10 a.m. today, we're going to get downward revisions likely to employment figures. Then we're going to get Fed minutes. But as Deutsche Bank Jim Reeds points out, that it's only revisions through March. It doesn't show the most recent data, so perhaps the Fed won't find it too consequential because they are judging the most recent labor market data. Your 10-year yield also a little change this morning after yesterday's rally across global bonds. It saw the 30-year yields drop to their lowest level year to date. Now, gold, that is taking a dip after trading at a record. So again, it's just a slight pause in all some of the euphoria and assets that we've seen. It's still above 2,500 and the bullish calls are still there. David Rosenberg of Rosenberg Research says it is only a matter of time before gold hits $3,000 an ounce because of all the usual catalysts, central bank cuts from the Fed, central banks buying gold, concerns over the economy, and because bond markets are not the best of hedges considering how volatile they are, and gold is under-owned despite all of that. Okay, now despite yesterday's slight declines, stocks have regained all the value that it lost and some over the past month. Chris Watling of Longview Economics writes this: judging the end of a pullback is critical. As the market rallies into wave 2 of relief rally, it is tempting to get caught up in the improving mood and reinstate equity long overweight positions. Chris Watling, CEO and Chief Market Strategist of Longview Economics, joins us now. Chris, I know you did write that a week ago, and since then, equities have continued to rally. So is it your estimation that the sell-off still isn't over?
Well, I mean, the price action's clearly been pretty impressive in this rally, but yeah, I think there's a very good chance that there's some real downside risk ahead of us. If you look back over all the price action of all sharp sell-offs, when you have the sort of first wave of selling as we had in late July through to early August, if you look at all the examples of that over the last sort of few decades, there's about 15 really clear examples, and in 13 out of 15 instances, you rally in your wave 2 relief rally, as we've been doing for a couple of weeks, and then you go back and you retest those lows. So I have to admit, I mean, the relief rally's been very strong, and perhaps a little bit stronger than I expected, but I still think that's probably your main framework. And it's interesting to me, if you look at one or two other risk assets out there, you mentioned 30-year bond yields making new yield lows, or you look at 10-year bond yields, they're just above where they were on the 5th of August at that low point, or certainly with oil's been selling off. So quite a few other risk assets are starting to behave as if there may be a bit of downside from here. So I think the next 2 weeks is critical. Watch the price action. I think if it doesn't sell off, the best it'll do is go sideways and maybe have a couple of wobbles. But so I think one can get a very good perspective on that. But certainly, and 13 out of 15 times, you'd expect to pull back to the lows that we saw around August the 5th.
Yeah, this disconnect between bond and equity markets, so many people have pointed it out, Chris, because bond markets are supposed to be the sanguine, the sobering view, but instead we've seen remarkable volatility in this bond market. What does it mean just for asset allocation to have bonds, as some people have put it, act like meme stocks, and really equities be a calm voice and just keep chugging along?
Well, it's a challenge because the sort of old 60-40 and of equities and bonds, that sort of classic weighting that's meant to give you that ballast, as you say, with bonds giving you ballast when equities sell off. The correlation between bonds and equities keeps changing, and it's changed a number of times over the last couple of years, and changed again recently with bonds actually rallying in the sell-off into August the 5th as equities went down. So they were doing their job then. So I still think one should have that balance in a portfolio. It does have some hedging qualities, particularly if inflation's now beaten. It's when you've got an inflation problem that it doesn't work as a hedge. And I think inflation is beaten in the States. The economy's slowing, and therefore, bonds are back to doing their proper role and hedging against equities and risk assets as they sell off.
When it comes to hedges, I wonder what you make of David Rosenberg's view of Rosenberg Research that I just mentioned, this idea that gold has further to run because households have high allocations to equities and they need a hedge, and they don't trust bonds currently because of everything we're just talking to, so therefore gold makes sense.
Well, I think gold makes sense because we're coming into a rate cutting cycle. And, we're going to start seeing some growth in money supply, which is basically, money creation as we look out 6, 12, 18 months. So, I like gold because I think it tends to do well in response to that. What I would say, though, is actually if I always like rule of thumb, most asset classes tend to rally for 2 to 3 years before they then had a sort of major give back for a year, 18 months. That's sort of a rough rule of thumb I like to keep an eye on. And of course, gold's been rallying since its lows in August 2020. So it's had a very long rally. It's done extremely well. It had a consolidation phase, and then it picked up that rally again earlier this year, back end of last year. So, there's a degree of tiredness to this rally. I think there's more to go for, but I'd say we're 80% of the way through, and we're gonna find as we get 6 months on. I guess what I'm saying is I wouldn't jump on hard on the gold trade. The best gains are behind us. There's probably still a bit more there, but it's limited in that once we started pricing in the rate cutting cycle, the sort of momentum behind it is going to slow.
Chris, just to take a step back, because you are a student of history in these markets as much as anything else. And it is in this moment, really the past year, that we've seen just this pendulum swinging back and forth between views of soft landing to hard landing to we're falling off a cliff to everything's okay to it's kind of slowing it. And you just see the volatility in asset classes in the meantime. What do you recommend to clients to do? Do you need to be more of a short-term trader to really capitalize off of some of these swinging views? Or is it you take a step back, you try to act sober, and you don't react to every market move?
I think the key here is if you're an investor, which I would regard as someone with a sort of 6 month plus time frame, 6 months to 2 years or beyond, you want to use a volatility as an opportunity. Sure, if you're a trader, try and trade it, and we have short-term products that look to do that. But if you're an investor, you want to think about what's the next big global macro theme coming out there? What's going to drive markets on the next 1 to 4 year time frame? And I think the key here is the fact we're getting into rate cutting cycles across the West. That's key point number one. And key point number two is that the private sector in the US, the UK, and Southern Europe and lots of other bits of Europe has healed. You know, post-financial crisis, it was in a mess. Households were over indebted. The corporate sector was tricky. The banks weren't in good shape. All of that's gone. That's now healed. The pandemic sort of accelerated that healing. And they're now in very good shape. Just look at Eurozone household savings ratio. It's at its highest it's ever been, except for in the pandemic. So there's a lot of firepower out there that will respond to falling interest rates. And that is what should dictate how you invest when you get these bouts of volatility. Because I think over the next 1 to 4 years, the driver of the global stock market is going to change. It's not going to be the Mag 7 anymore. It's going to be much more classic cyclicals, more non-US equities as well, some mid and small cap US. So that's how I'd approach it if I was a long-term investor, which actually I suppose I am in a sense. But if you're a trader, of course, play the swings. But that's a totally different ball game and a totally different set of tools to go about doing that.
Chris, well said. We'll leave it there. Chris Watling of Longview Economics, thank you for your time this morning. Okay, let's get you some other top stories that are trending on the terminal this morning. Now, after 2 days of search and rescue efforts, British tech entrepreneur Mike Lynch and Morgan Stanley International Chairman Jonathan Bloomer are feared dead. They and 4 others are expected by rescuers to still be aboard the sunken wreckage of a luxury yacht off the coast of Sicily following a storm. The Pentagon's intelligence agency said Ukraine and Russia both lack the military assets to mount major offensives against each other. The conclusion, the two are now headed for a stalemate, at least for now, despite Ukraine's incursion into Russian territory. And a federal judge has ruled that the FTC lacked authority to enforce its near total ban on non-compete agreements. The ban was set to go into effect next month. Now the FTC have the chance to appeal the ruling. The ban was an effort to make labor markets more competitive. Now, coming up on the show, Walmart ends its partnership with JD.com in China. We're going to talk about how Walmart is refining both its digital strategy and its strategy in the country. We're also going to look ahead to revisions in the payrolls data, what to expect later in the week from Jackson Hole. We'll catch up with Charles Schwab's Kathy Jones on your Bloomberg Brief this morning.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
This week, Balance of Power is live in Chicago for the Democratic National Convention.
So we've got a race here, and the sprint begins.
We'll bring you breaking developments.
Vice President Kamala Harris closing the gap with Donald Trump.
And informative analysis, all leading up to special coverage Thursday evening, including Vice President Harris's acceptance speech as the Democratic nominee for president.
As president, I will show Donald Trump what real leadership looks like.
Tune in all week on Bloomberg Television.
It's your Wednesday edition of Bloomberg Brief. I'm Danny Berger in New York. Walmart is winding down its 8-year partnership with JD.com. In doing so, it's selling over 144 million shares of JD. That's about $3.6 billion worth. It is a change in strategy for Walmart in the world's second largest economy. Let's get over to Dasha Afanasieva on this. Dasha, what does it tell us about a strategy shift for Walmart?
So Walmart's not leaving China at all. It actually has a really strong business in China through Sam's Club, which is the hypermarket that works on membership operations, memberships. And that's actually, its China sales are growing double-digit thanks to this format. Members pay, and the incomes from that is growing something 26%, just the membership incomes. So people are just flocking to join this hypermarket. So when you compare that to JD.com's sales growth, it's just a lot more impressive. So it kind of makes sense that they'd want to deploy these billions in capital in their own business there rather than go for JD.com, particularly if you think about the backdrop of the weak Chinese consumer. Sam's Club only works so well because it's seen as such a good deal and a bargain, whereas JD.com is more of a proxy for the general strength of that confidence and buying power.
And Walmart, in talking about this, at least to Reuters, reflecting a lot of what you're saying, Dasha. The other thing I was interested in, they go through saying that they're going to focus on, as you say, Sam's Club in China, Walmart China, but also it helps them deploy capital towards other priorities. In this moment, Dasha, we've been talking about the weakness of the consumer, yet Walmart comes out with these blockbuster earnings. What are the opportunities for Walmart right now? What are they growing? What are they focusing in on?
Well, from last week's results, what I found really interesting is the AI capability part. So a lot of companies are talking about AI, the opportunities in AI and how it's such a game changer and that they're doing stuff, but being very, very vague in terms of what they are actually doing, short of, having AI make adverts so you don't have to pay actors and stuff. And last week, Walmart said that AI helped it create or improve 850 million data points that then, help it predict the demand for its products. And that if humans had done this, then they would have needed 100 times as many people to do it sort of to the same quality and in the same time frame. And I just found that fascinating because really huge companies are challenged by, smaller players, and there's a lot more competition on the internet because you can find all these other suppliers. And I think what massive companies have to offer is this kind of investment that's going to make them more cost effective. Separately, I think that Walmart can deploy this capital in chasing the US consumer and kind of doubling down on the strategy of offering value, doing own brands, investing in creating white label products that then you're going to have both the wealthier consumers trade down to, and you're going to have sort of the poorer end of the consumer that's really, really stretched at the moment is also going to be attractive to them.
Yeah, Dasha, I thought that AI part was really fascinating too. Without the use of generative AI, as you say, this work would have required nearly 100 times the current headcount to complete the same in the amount of time. That from their CEO on the call. Dasha, thank you so much. We'll catch up with you later in the show to get a look ahead to the earnings to come. Bloomberg's Dasha Afanasieva. Okay, let's get your quick check on markets this morning. Going a whole lot of nowhere. Equity is slightly higher. They did snap 8 days of gains yesterday. Had they done 9, it would have been the longest winning streak since 2004, but we can put that statistic aside. The rally in bonds also takes a breather, as does the rally in gold, still above $2,500 an ounce. Okay, coming up, we're going to look at some of the headlines around the world, from politics to geopolitics. Blinken leaves the Middle East. This is Bloomberg.
The top names in business are on Bloomberg.
The challenge for us now is not very much on the product, it's on the ramp-up of the production system.
We turned the industry down to almost zero during the pandemic. And what we're trying to do now is turn it all the way back on. And that's hard. We lost not only people during the pandemic, we lost a tremendous amount of experience.
A lot of skilled people have left the industry. We have to hire new people. The supply chain has to hire new resources and train the people, educate them.
And because those roles are filled now not by a 58-year-old, but perhaps by a 28-year-old, there's a lot we have to do in terms of not only adding capacity, but capability to meet the ramp that we all are embarked upon.
We have thousands of suppliers, and when you have just a couple of them, few of them that are late on the ramp-up, well, that's slowing down everybody, and that's what we've been facing earlier this year.
Nobody covers business like Bloomberg. Context changes everything. Lots happening on Wall Street.
That couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From business's most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
It's your Bloomberg Brief. I'm Danny Berger in New York. Let's get you some front page news, what's making headlines around the world. First up, on the New York Times, Biden approved a secret nuclear strategy refocusing on a Chinese threat. It's a classified document. Biden ordered U.S. forces to prepare for a possible coordination nuclear confrontation with Russia, China, and North Korea. The Pentagon thinks that China's stockpiles will rival the U.S. and Russia's over the next decade. Next up, The Guardian has this: ceasefire is elusive as Biden leaves the Middle East, as Blinken rather leaves the Middle East. The U.S. Secretary of State ended his 9th visit to the Middle East since October 7th without a truce. Of course, he had been saying that this was one of the last chances to get so. Blinken told reporters the deal needs to get done in the days ahead. And now front pages across the nation, let's be honest, they are displaying the face of former President Barack Obama and Michelle Obama after they energized the Democratic National Convention in Chicago last night. Here's what they had to say about both Harris and Trump.
We do not need 4 more years of bluster and bumbling and chaos.
A handful of votes in every precinct could decide the winner. There is no other choice than Kamala Harris and Tim Walz.
America's ready for a better story. We are ready for a President Kamala Harris.
Joining us now is Bloomberg's Vonnie Quinn, up throughout the night in Washington, D.C., keeping a track of the DNC. Vonnie, great to talk to you. You have this energizing force from both of the Obamas, and not only did they lean on them in the DNC, in their speeches, but we also learned that Kamala Harris brought in veterans from Obama's campaign. Just talk to us about the strategy of really bringing the Obama camp in to the Harris camp.
Yes, a lot of coordination, actually, Danny. But when you think about it, David Plouffe, who ran the 2008 campaign, you also had Jen Palmieri, who was a former communications director through the Obama years, the person who was responsible for the battleground states. They have a track record. They have made sure that a person of color got into the Oval Office. Nobody else in the country has done this. So there is the sense that perhaps they can do it again. Can they? Well, it's up for discussion. It has been quite some time since that all happened, but they do have that track record, and they will be going after the Obama coalition, the so-called coalition of voters, the multicultural, multi-religious, multi-ethnic group of voters that helped Obama get into the White House the first time round. There's also obviously a huge support from the Obamas that you saw tonight. And there is that urgency, a threat almost in the atmosphere. I just want to quote Michelle Obama, who spoke before Barack Obama. She said, "This is going to be an uphill battle. We need to vote in numbers that erase any doubt. We need to overwhelm any effort to suppress us." So this has been a thread that you've seen throughout the last several weeks. Kamala Harris has said it herself as well. Let's not get complacent. If we need to get more voters, then we need to be acting right now. We have less than 80 days. It's something like 77 days as of today. One of the rallying cries that Michelle Obama started up was, do something. So if you feel like complaining about something or complaining about how things are, we don't have time for that. Get on the phones, get the vote out, get people registered.
Yeah, finding purpose in your rage was the line that she used. Meanwhile, counter-programming, Vonnie, Donald Trump was speaking to Livingston County in Michigan, to sheriff's the office there, saying that I am not a radical at all. I'm just a common sense person that was successful. This is kind of interesting, Vonnie, because they're trying to define Kamala Harris. Both are in a rush to do this. And here's Trump kind of talking about himself in this sense, saying that, you know, I'm not the weird person people are casting me as. I'm the common sense candidate. Where do we stand in this effort to define the candidates? Obviously, Trump is extremely well known, but time is running out as early voting starts in just a few weeks.
Yeah, I mean, this kind of comes out of the blue, doesn't it, Danny? It shows that he's been needled a little bit. I'm not sure anybody would consider Donald Trump a quote-unquote common sense candidate, not even his own supporters. I'm not sure that his supporters even want him to be a common sense candidate. It's clearly a response to this idea of weird being thrown around since Tim Walz debuted that word several weeks ago. It's really caught on, and it's circulating among Democratic leaders and all of the Democratic grassroots as well. Even Barack Obama tonight, he talked about Donald Trump's quote-unquote weird obsession with crowd size, and that was a line that went down very well at the United Center in Chicago. So yes, Trump definitely trying to rebrand himself. He's taking the advice, obviously, of elders in the party and his aides that he should play down the idea that he enjoys getting involved in culture wars and that he should go after policy. He can't help but try and come up with his own sort of insults for Kamala Harris, calling her a lunatic and making mention of her laugh and so on. And by the way, the second gentleman, Doug Emhoff, tonight said he loves Kamala Harris's laugh, and that was also a line that went down very well in the convention center. So Donald Trump is continuing to counter-program. He's going to be in North Carolina, another very, very crucial swing state, on Wednesday, and Arizona on Thursday. And as we heard at the Democratic convention tonight, these are states that the Democrats are going to have to win big in order for there to be no question if they want to win the White House.
Yep, the swing state tour continues. Vonnie, thank you so much. Bloomberg's Vonnie Quinn. Okay, coming up, vanishing U.S. jobs. We are going to get the annual payrolls revision later today. We're going to look ahead to that in Jackson Hole with Kathy Jones of Charles Schwab on Bloomberg Brief.
recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure. Don't miss Bloomberg's interview with the
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. An 8-day rally halted. Stocks now steady ahead of Fed minutes and revisions to the jobs data. And Walmart drops JD.com, shares the tech giant sink after Walmart sells its $3.6 billion stake. And the Obamas rally voters at the DNC, praising VP Harris and ripping into Trump. So the 8 days did not turn into 9, and this morning, markets going a whole lot of nowhere. S&P 500 futures, let's call them, and both the 10-year yield basically unchanged. The next potential catalyst we might get comes at 10 a.m. today, a downward revision to employment. But as Jim Reed from Deutsche Bank points out, it only goes through the March data. It does not have the most recent labor market data in it. So we'll need to judge its importance to the Fed based on that. Your 10-year yield, it is at 3.8%. There was a rally yesterday that sent 30-year yields to their lowest so far of the year. Reminder, we're also going to get Fed minutes today, but we've had a lot of Fed speak in the meantime since the last Fed meeting. Meanwhile, gold, that also takes a breather in its historic rally, down 0.2%, just above 2,500. It hit another all-time high yesterday. David Rosenberg of Rosenberg Research says that $3,000 an ounce is in view, given the volatility in bond markets and an under-owned consumer and household to gold. It makes more sense as a hedge at this moment. Now, I mentioned it. The Fed's going to be releasing its annual revisions to the U.S. payroll data that hits at 9 a.m. New York time. Let's get over to Bloomberg's Jill Desis for more on this. Jill, there seems to be a lot of debate around how much importance we should put on the revisions. So what are we likely to see, and how much attention should we actually be paying?
Well, Danny, yeah, I think as you just pointed out, this is really, this is annual data that really just runs through March. So this doesn't really reflect any of the recent, labor market weakness or anything like that we've seen in some recent non-farms. So you can debate that, oh, well, it goes back to March. So really, I mean, it's not really that core recent jobs data that we're really looking at. That being said, Danny, I mean, what I think a lot of analysts are looking for is how weak that downward revision is ultimately going to be. This is, something that we normally see with this kind of data, but the revisions, the estimates are pretty vast. I mean, you've got Goldman Sachs estimating that it's a downward revision of something like 1 million in payrolls growth there. I think, you've got some others, JPM, that's suggesting maybe it's just 360,000. So some big variance there. I think, though, anything that this data tells us, Danny, is that if it's a pretty significantly large revision downward, maybe that suggests that actually some of that weakness in the labor market had its roots much earlier than more recently. And so maybe that's a bigger cause for for concern for traders right now, particularly if they're thinking that the Fed isn't moving fast enough to cut interest rates. All of that is kind of what we may see in this data. And I would also just point out, Danny, that, I mean, Fed Chair Jay Powell has made this importance of jobs data. I mean, all data is important, but jobs data has really been really at the forefront of the Fed's focus right now. And I think just going into Jackson Hole, anything that suggests, again, like a really, really large revision could create a little bit of concern there.
And to that point, Jill, just talk about the concern and basically the fragility of the bond market going into this data point. Because we've seen, let's be honest, tier 2 data points, things that usually don't impact the bond market, do so in the past few weeks.
Yes, Danny, I mean, I think that at this point, look, there's, a record amount of leverage in the bond market right now. I mean, we just released some analysis recently. I wrote it down saying, there's roughly $1.5 billion worth of risk riding on every basis point worth of yields right now. That's pretty crazy right now. This is obviously as, traders are betting on the Fed to cut interest rates. So I think that there's, that significance there that any kind of, big revision one way or the other can really sort of risk, creating, some volatility in markets here. I mean, as you mentioned, just a few weeks ago, the most recent set of jobs data that we had, there was quite a bit of fluctuation just within a minute there on, 10 or so basis points worth of fluctuations there. So I do think that as, people are waiting on some additional data, anything that's really going to give us some idea of where the Fed's standing as, we head into not just, this Jackson Hole conference, but also into the Fed meeting next month, that's going to be something that people are really, really paying attention to. We'll just have to see if this, likely downward revision is as big as, say, Goldman Sachs says it may be.
Jill, appreciate it. Bloomberg's Jill Desis there. And this just out from Paul Donovan of UBS talking about the revisions. This does not change anything about the economy. Making payrolls marginally less inaccurate is about spin, not substance. Well, when it comes to substance, we have been getting some Fed speak. Fed Governor Mickey Bowman was speaking yesterday. She said this: should the incoming data continue to show that inflation is moving sustainably towards our 2% goal, it will become appropriate to gradually lower the federal funds rate to prevent monetary policy from becoming overly restricted. Let's cross over to Kathy Jones, Chief Fixed Income Strategist at Charles Schwab. Kathy, we can talk about the jobs market revision in a moment, but I first want to touch on what Bowman said. That doesn't sound like someone that's ready to cut in September. That is a Bowman waiting for more data. What does it mean if Powell doesn't have unanimity heading into Jackson Hole and his ability to sound overly dovish?
Well, hi, Danny. I think that having Bowman even concede that it's possible that there could be rate cuts is probably a big move. She's been one of the sort of uber hawkish people at the Fed. I think he could probably get unanimity. I don't think he necessarily has to have it in order to get a rate cut in September or sound dovish at Jackson Hole coming up on Friday. There's enough other people at the Fed, such as Austin Goolsbee, Raphael Bostic, Mary Daly, all sort of indicating that, yeah, we're moving in the right direction, that inflation is pretty much at their target. So I'm sure for the first rate cut, the Fed would love to have unanimous consent on that. But if they don't have it, they can still move.
Well, part of the reason I'm interested in this idea of unanimity is because it's September. It's when people are already starting to vote. It is an election year. And Steve Rashudo of Mizuho puts it out basically saying that if they're going to cut into an election cycle, they need to have everyone in agreement. Are you saying that it's not really consideration of theirs?
Yeah, I don't think so. Again, this is a Fed that likes unanimous agreement, pretty much has had unanimous votes on every move that they've made over the last couple of years. So I'm sure that they want it, they don't need it. And I think in our minds, the election looms larger than it does for the Fed, just simply because they're quite aware of the long lags between their policy changes and what happens with the economy. So they really wanted to influence the election. It probably would have started 6 months ago or even earlier to have that impact. So I think that the election is not going to prevent them, or one vote is not going to prevent them from making a move if they think that that's appropriate.
Fair enough. I mean, look, there's a lot of things that we'd want to hear from Powell in the next couple days at Jackson Hole, Kathy. Whether or not he actually delivers them is another story. Putting aside, whether they're going to go 25 or 50, because we're unlikely to hear that. What do you want to hear from Jay Powell that would be helpful to understand as we near the start of the cutting cycle?
Well, there are many things I'd love to hear. I don't think that we'll hear them, many of them, but I'd love to hear a clear signal that, yes, we're ready to cut rates. That would put, September pretty much on the books. I think it's an overwhelming consensus that they'll cut 25 basis points in September. Would like to hear a very strong indication from Powell that, yes, that is the plan. He's probably not going to pre-commit too much more than maybe, yes, we're ready to start gradually lowering rates at upcoming meetings, but that would be enough to say, yeah, September seems very likely. Would love to hear more about the balance sheet because I think that it's going to be difficult for the Fed to continue to wind down the balance sheet in the next 6 months or so. I'd love to hear a little bit more consideration about how that's going to play into the calculus. I would also love to hear what Fed believes the neutral rate is right now. There's been a lot of debate about this. I think it's very much up in the air. That would be very helpful, I think, for the market to price in longer duration bonds to say, where are we going long term with the neutral rate relative to where we're going with inflation? So those would be the big things, but I don't think we'll get precision and clarity that we're hoping for. We'll probably just get some strong hints.
I guess it's nice to have a wish list, even if none of it is likely to get ticked off, Kathy. I mean, you mentioned what we are likely to hear is what we've heard from other Fed speakers, the likes of Daly, of Goolsbee, of even Kashkari most recently, talking about gradualism, talking about a slower pace. Kathy, is this bond market that's pricing in still about 100 basis points of cuts so far this year and 200 looking out a year from now, is the bond market pricing in that offsides heading into a Jackson Hole where gradualism might be the theme?
Yeah, the bond market's been getting ahead of itself now for the last 2 years. So every time, because the Fed's data dependent, right? Every time we get a data point, the market tends to react to it and maybe overreact to it. And I think that we are pretty much pricing in as much of a cycle as is reasonable to expect. When you look at, the 10-year at 380, that's fair value to us for this cycle. So they're well ahead of themselves. So certainly vulnerable to some surprises. And I think that's why we've gotten some of the volatility that we've seen in the last 6 months or so. Nonetheless, I do think that's an accurate reflection of where we're going. It's just that we get there really fast. If Powell disappoints, yeah, we could get a backup in rates and get some more volatility. But it seems unlikely that he's going to stand there and deliver a hawkish message.
Given the ability of markets to overact, Kathy, how much do you care about the jobs data revision this morning?
Not too much. It will be interesting because we've had so much noise in the data, and the survey responses have been quite low. So there is a lot of concern that we're not getting an accurate view. If it's a substantial downward revision, that may tell us that the pace of job growth has been slower than expected and that the Fed maybe was misled by that or certainly miscalculated just how tight the job market has been. But it's pretty old data at this stage of the game, so it shouldn't have a major impact on the market.
Yep, they'll only show the revisions through March. Hey, Kathy, we really appreciate your time this morning. Kathy Jones of Charles Schwab. Coming up, Macy's and Target will report earnings before the bell. We're going to have more on another read, yet again, from the U.S. consumer this morning on Bloomberg Brief. Stay with us.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow.
And these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Why should I want to invest in the pharmaceutical industry? Is it going to continue to grow as it did last year? And what about your own company? Do you think it's going to have good growth prospects over the next couple of years?
I think the reason to invest in the sector is the science. I mean, when you look again, if I go back into the history, for most of the last century, we were only giving people pills and small molecule drugs. Then we discovered that we had this whole world of biologics, and we could treat diseases with biologicals. More recently, we've discovered that we can reprogram your cells, we can edit the genome, we can use these RNA therapeutics to completely transform areas of medicine. Those technology areas are at their very nascent stage, and what we're going to find is they're going to open up whole new areas of growth from our business standpoint and a human health impact standpoint. We hope that as we work in our areas like cell therapy and RNA therapeutics, we will also be able to climb to a whole other level of market cap over time.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Welcome back to Bloomberg Brief. Danny Berger here in New York. Okay, let's take a look at some of the couple of retail names. We're going to start off with Walmart and the announcement they made this morning. They are ending an 8-year partnership with JD.com in China. You can see shares of JD down 7.75%. The move, or rather 0.5%. The move led a broader sell-off in Chinese e-commerce and tech shares. Let's get more with Bloomberg's Subrat Patnaik. So, Subrat, why now? What is the strategy shift that Walmart is undergoing?
Morning, Danny. Yeah, it's a very interesting kind of move for Walmart to make at this juncture. But we've realized that they made an investment around 8 years ago, and things in the Chinese e-commerce market looked very different. We had Alibaba in the lead, then we had JD, and then PDD was kind of smaller. But with the advent of Temu, the entire landscape has kind of changed. So we have industry insiders telling us that basically Walmart might have picked the wrong horse in this race. It also opens up a lot of money for Walmart to invest in various other projects, Sam's Club, different geographies, different investments. So yeah, it's interesting in both ways, but yeah, it comes at a very interesting juncture.
Yeah, Walmart saying that it allows them to focus on strong China operations for Walmart China and Sam's Club and deploy capital towards other priorities. Subrat, how much of this is also just about Walmart's strength in technology and the lack of need for a partner to get some of their priorities done?
We've seen in the past that Walmart has made investment in other companies and trying to make it work. But when it comes to Walmart and tech, it's not been very successful in acquiring stakes or businesses and turning that around. So this is just one other example. So that is a little worrying when it comes to other Chinese names, and we've seen the sell-off. Just note that this morning the ADRs are not selling off as much as we saw the sell-off in Hong Kong. So it does seem to be more of a JD problem rather than a wider e-commerce China ADR problem at the moment.
Hey, Subrat, appreciate it. That is Bloomberg's Subrat Patnaik. Okay, staying on retail, we're also going to get Target, Macy's, and TJX reporting before the bell. The results give us just another read on the U.S. consumer. Let's get back over to Bloomberg's Dasha Afanasieva. Dasha, companies more than ever are talking about the consumer this quarter, but they are squarely divided from strength and weakness. Walmart, as we were just discussing, being one of the ones seeing strength, expecting profits to expand. So in this next set of readings, what are you going to be looking out for?
Well, I think everyone's agreed that the consumer is stretched, but it's where different retailers position themselves that determines whether they weather that storm well or not. So if you look at Macy's, we're expecting a more cautious tone from the retailer, and I think the market really wants to see it focused on strategy, especially now that talks with Arc House and Brigade have ended. And in terms of TJ Maxx and Target, both of those are bargain names that, giving consumers sort of this idea that they're getting a good deal. Target because it's quite cheap, TJX because it's got this range of sort of discounted designers and discounted branded products. So they might actually have an opportunity to strike a more positive note. Also because the second quarter last year was quite soft, so there's a better basis for comparison there.
We've also seen all this volatility in turnover of C-suite in consumer-facing brands. The most recent high-profile example, of course, Starbucks, but also Victoria's Secret having turnover too for their CEO. Is there a sense, Dasha, that strategy in a slowing environment is now more important than ever?
Yeah, I mean, if you look at the Starbucks share reaction to appointing the Chipotle CEO, rose 10%. So now consumer companies know that there's that option on the table if they want to get a positive share reaction. You can look to Nike, which has had a lot of problems. So there's a lot of talk there. And I think that the strategy is key, and getting confidence, market confidence on your strategy, and in particular, the recognition that if it's so difficult to grow the top line, what are you going to be doing to boost the bottom line? What are you doing in terms of cost savings? What are you doing in terms of your headcount? What are you doing in terms of tech investment to make you more efficient, to justify having these massive companies? And I think that's what traders will be looking to. And it's not just the extreme of CEO turnover. You've got activists really live, really active in the sector. Nike, Starbucks, Reckitt, Bankiza in Europe. So CEOs should really be on alert, I think, and come in really confident in terms of how they're maneuvering in this quite challenging environment up until at least interest rates are cut.
A message of a warning from Bloomberg's Dasha Afanasieva. Play that for all the CEOs around the world. Dasha, thank you so much for all your work this morning. Okay, let's get a quick check on futures this morning, because they are not very changed unless you're looking at Russell 2000. In this recovery from this market, we are back where before we were on the July 31st rate decision. We've come back from that and plus some. Russell 2000 futures have outperformed in the past 5 days. Russell is up 3.33% versus 2.5% for the S&P 500. The rotation trade is kind of coming back. Will Powell help that by signaling rate cuts, but an economy that's not falling apart? NASDAQ 100 futures, those are declining, perhaps underperforming because of Walmart selling their JD.com shares and those ADRs dropping precipitously. Okay, coming up, we're going to get you set up for your trading day on this Wednesday. We have some jobs data in minutes ahead.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get Get ahead of tomorrow's trading with The Close, weekdays on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Today, Bloomberg is live at the Jackson Hole Economic Symposium, bringing you news and interviews with Fed leaders and other economic experts. Tune in for continuing coverage leading up to a special episode of Surveillance August 23rd at 9 a.m.
It's Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading day ahead. We're going to get major retail earnings. We're going to hear from Target, Macy's, and TJX all before the bell. And then the Labor Department will be releasing revisions to their payroll data at 10 a.m. Eastern. Those show revisions up through till March, so it doesn't have most recent data. We're also going to get the latest Fed minutes. Those come out at 2 p.m. And then it will be day 3 of the DNC. It will feature Governor Tim Walz. Now, just a reminder, yesterday was a day of the Obamas. We heard from Michelle Obama and Barack Obama talking about unity and pushing forward, having this message of democracy under threat. Some of what we've heard from Biden. Let's just get a reminder of what we heard.
As any policy or program, I believe that's what we yearn for. A return to an America where we work together and look out for each other. A restoration of what Lincoln called, on the eve of Civil War, our bonds of affection. An America that taps what he called the better angels of our nature. That is what this election is about.
Meanwhile, Donald Trump was speaking in Livingston, saying, I'm not a radical at all. I'm just a common sense person that was successful. He was speaking to the sheriff's office in Michigan. Of note, also, Harris and Walz were in Milwaukee when the Obamas spoke. Of course, Walz, as I mentioned, will be in Chicago today, delivering the address for the DNC. Okay, let's look at some of the shares on the move this morning. JD.com, the ADRs are declining this morning. Walmart selling their stake, about $3.6 billion worth. Those shares down some 7.5%. Meanwhile, Keysight's Technology, they reported earnings, a really strong rally afterwards for the technology company, gaining some 12%. Meanwhile, it's pretty steady, pretty quiet in the rest of bond markets. How big of a catalyst will job market revisions be? There we are mixed. The thought is if the revisions are large, it shows that perhaps there was some weakening in the labor market far sooner than we expected. But of course, it doesn't have the most recent data. So equity futures unchanged, except for Russell 2000. Small caps continue to outperform. Will this economy be able to thread the needle of allowing for rate cuts, but not falling off a cliff? A quick check on your bond market this morning. The rally taking a break. You saw the rally after Rick's bank cut, after weaker CPI data from Canada. So it was really a global rally. 30-year yields, though, yesterday fell to their lowest level of the year. Your 2-year yield just below 4%, 10-year yields at 3.8%, 30-year at 4.07. All right, that's it for Bloomberg Brief this morning. Surveillance, that's up ahead. It's a beautiful look of the blue moon.
what legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow. I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No. Myself, 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
There's been a step up in concern about the consumer.
There's probably a little bit more downside risk in the economy than the markets may appreciate.
Good situation here. Things are indeed getting better.
There's enough good going on to offset whatever the weakness is.
Overall, the consumer is hanging in there. That's why the economy is going to continue to expand.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your trading day started live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now with your equity market shaping up as follows on the S&P 500. Equity futures just about unchanged after snapping the longest winning streak of the year so far on the S&P. Once again this morning, chipping away at recent gains on the Nasdaq 100, lower by 0.1%. Things are quiet at the moment. They pick up a little bit later. Your day ahead looks like this. We get some earnings from the likes of Target and TJ Maxx. You get a sprinkle of politics and Fed minutes this afternoon. But at 10 a.m. Eastern time, that might be the main event for financial markets. Lisa, a revision to a year's worth of non-farm payrolls.
The expectation is it could be anywhere from a revision downward of about 360,000 jobs to potentially 1 million jobs that will be taken off the year ended in March for this year. Here's the key question. Do we end up with a downward revision that essentially is the biggest in 15 years, which is any downward revision that exceeds 500,000? This, to me, just gives you a sense of, wow, could we see another narrative shift if this really does surprise in the wrong kind of way?
What strikes me as absolutely mental, like seriously mental. Listen to this range from the likes of Goldman Sachs, so a group of really fantastic economists led by Jan Hatzius. A range of anywhere between a revision of 600,000 to 1 million lower. That's anywhere from 50 to 85K per month. So we're sort of setting the tone for Jackson Hole and Chairman Powell's address this Friday in a rather peculiar way.
So this really goes to the perilousness of being so data dependent on data that has proven to be time and time again, not unreliable, but fudged. At least when you look at it in the past view, the rear view mirror. Here's the issue. This is the preliminary revision. We get the final revision at the beginning of next year. And what they're basically doing is taking the quarterly census of payrolls and pairing it with some of the other data that they collect. There have been issues with survey responses. The issue is that this will really color how much momentum there is in the labor market at a time where we already are seeing cooling. Does this cast another shade on that non-farm payrolls report that was disappointing last week?
This is a really important discussion, and I often reflect on some of the words from Chairman Powell from back at the start of July. in Sintra, Portugal at the ECB get together when he said, because the economy is strong and the labour market is strong, we have the ability to take our time to get this right. So how strong is this labour market and how much time do they actually have?
Does this change the conversation in terms of the balance of risks? We already saw yesterday, albeit a quiet day without a real obvious catalyst, the chance of a 50 basis point rate cut increasing, and if you look at Fed funds futures. So people looking at the odds that maybe he could come out and talk about the need to get ahead of any kind of downturn. Key question is, how do we have a good gauge of an economy that already the Fed kind of got wrong due to some of this data that got revised to the upside back a couple of years ago in the post-pandemic fog? Is this going to be a similar kind of revision, although in the opposite direction, that really flavors the conversation in a different kind of way?
That data drops in about 4 hours' time, so look out for that. As for the earnings, target at about 6:30 Eastern. We'll break those numbers for you in about 27 minutes' time. For the broader market, equity futures on the S&P 500 just about unchanged. In the bond market, on various points along the curve, we are near the lows of the year on a closing basis. On a 10-year right now, 381.42. Yields up by almost a single basis point. Things a little bit calmer in the FX market here, Lisa. Euro dollar in and around 111.
This is a quiet period, right? This is sort of the more typical dog days of summer. That said, it is important to reflect on where we've come from. I love this quote by Bespoke Investments, that markets usually take the stairs up and the elevator down. But in this case, it took the elevator both ways. You saw some of the biggest swings from oversold to extreme overbought to then overbought, going back to World War II. So a little bit of calm, kind of welcome on a day like today.
Just a little bit of calm. And on that calm morning, this is the lineup for you. And I'll go through it rather calmly for you. Andrew Sheets of Morgan Stanley on risk to his soft landing view. Anne-Marie with the latest from the DNC in Chicago. And Torsten Slock of Apollo on some big revisions to US jobs data. We begin with our top story. Stocks holding steady ahead of those revisions at 10 a.m. Eastern Time. Andrew Sheets of Morgan Stanley writes in the following. The Fed chose to remain on hold in July despite less inflation, despite rising unemployment. Policy works with a lag. Once the Fed is behind, it often struggles to catch up. Solid data, not dovish Fed speak, are what's most important now. Andrew joins us now for more. So Andrew, let's get straight into it. Despite those comments from you, you say keep the faith. Keep the faith in corporate credit and maybe keep the faith in that soft landing too. Andrew, why should we keep the faith?
Yeah, thanks. Good morning. It's great to be here with you. So look, I think this is a market where the growth data is now in the driver's seat, where I think the market is rightfully focused on the importance of growth holding up. And if the Fed is late, if policy is too restrictive, then rate cuts might arrive too late to do anything about that. But our expectation is that the growth data will hold up, that we will see a soft landing, that the consumer is strong enough to support this expansion continuing. And I think that sort of moderate growth, moderating inflation, moderating policy rate that we expect at Morgan Stanley is a pretty good backdrop still for corporate credit.
How important are those revisions that drop at 10 a.m. Eastern Time, Andrew? When we talk about how strong the labor market is, do we really know how strong the labor market is?
Yeah, so I actually thought your lineup today is a really great sign of what the market's focused on. We have retailer earnings, the state of the consumer, incredibly important for where the economy is. The labor market revisions, where the job market is very important, especially. And Lisa, to your point that you mentioned earlier, the Fed is very focused on the labor market, but the labor market tends to be a lagging indicator. So, you do have this environment where if the labor market starts to show weakness, history would say that that's almost already too late. So the labor market's very important. And then we have the Fed minutes. And so how is the Fed thinking about all this? And is there more insight to how restrictive they really think policy is? But yes, I think the growth data is at the center of this discussion. And I think the labor market data, the weekly jobless claims numbers that we're going to be getting, the next non-farm number, these are all going to be really important.
What would you have to see, Andrew, today in the revisions for payrolls, or the initial revisions, that would make you rethink the likelihood of a soft landing?
Yeah, so I think something that would be significantly different than expected. I also do think that this is an area where I think the market will look at a variety of data. And so, it's not just today's number, but it's going to be Thursday's jobless claims number. It's going to be the next non-farm number that's important. And, I think it's also about how much, we see from some of these other measures, some of these survey measures like ISM, like the index of leading economic indicators, a number of things which have been genuinely mixed. So, to today's revisions are notable, but I think the market's going to also be focused on a variety of metrics and certainly some of the upcoming more kind of real-time measures as well.
Andrew, I gotta say, I read a lot of notes last night, and I was struck by the tone in all of them, where the downside risks to the U.S. economy seem to be growing. That is something that I saw again and again, and that people have increased conviction in going into risk assets because the Fed is going to respond. It seems like these two ideas are a bit contradictory. Can you explain why they're not?
So actually, I think they are contradictory. I think that if your mindset is the data is going to weaken significantly, but it's okay because the Fed is going to cut and potentially cut aggressively, I think you're actually fighting quite a bit of history with that. I think historically when we've seen weaker data and more rate cuts, more aggressive rate cuts, that's been a bad outcome for risk assets. That's been a bad outcome for credit. Kind of the more the Fed's been cutting, the worse it is, because that often represents significantly weaker economic outcomes, and the benefits from those lower rates don't arrive in time. Policy works with a lag. So I would say our constructive view is kind of the other way around, is based on the view that we think the data will hold up. The Fed will cut modestly. The Fed will cut steadily and slowly, and that will be a combination that's consistent with a soft landing. But I think in a scenario where the data is weaker than expected and the Fed is cutting more, I think the market will be weaker than we expect.
So, Andrew, if I were to close this interview now, say thank you as always, it's great to catch up and walk away, the first thing I'd say to Lisa is, I think he's probably long consumer cyclicals in credit here. Andrew, are you long consumer cyclicals in credit?
So I think the challenge in credit is we don't necessarily see a great deal of risk premium in the cyclical parts of the credit markets. We tend to like the financials a little bit more. That's a cyclical sector that we think there is still some risk premium. I would say within the retail sector, our sector credit analysts will highlight, you see quite a bit of dispersion there. You actually have seen some quite good earnings reports from some of the retailers in the second quarter and some weak ones. So I think it's a sector where we're more focused on kind of the relative value. Overall, the risk premiums don't seem particularly notable.
There's a larger issue here, too, which is whether the U.S. is just more generally overpriced at this point if you're looking at some sort of recovery or some sort of Fed that could intervene in a correct time. Not to go too far off the beaten path, but I was looking at your notes and seeing that you like Chinese credit, which just sort of highlights sort of a search for yield at a moment where you see U.S. companies moving out of China and an increasing aversion to just geopolitical risk. How do you justify this idea that this is a fraught moment with a real question mark around the Fed's response function, and yet it is a good time to go risk on into areas that are some of the least loved?
Yeah, so I think China investment grade is kind of an interesting dynamic where we think kind of weaker growth, weaker inflation is working in the favor of the bondholder. So, I think whereas the focus in a lot of other regions has been inflation might be too high or too sticky, I think China is the economy where there's the greatest risk that inflation is too low. Not just this year, but kind of in future years. There's a higher risk of a deflationary sort of risk scenario. And that sort of scenario can actually be quite good for total returns for bonds, especially long-term bonds. Companies in that scenario are not releveraging, they're deleveraging, the economy is deleveraging, yields are falling, policy rates are staying low. So, we think in that environment you see both kind of total return benefits from a low yield environment and lower yields boosting the returns for China investment grade bonds, and also an environment where those lower onshore borrowing rates from banks, as rates stay low or even go lower, kind of incentivize companies to borrow domestically rather than financing in the dollar bond market, and that can be good for keeping supply low and, again, kind of supporting the bond market there.
Andrew, you are one of the best, sir. Appreciate it. Thank you. Andrew Sheets there of Morgan Stanley out of London this morning on corporate credit. Two-part story there. The tone of the story, the price of the story. When you hear the tone of the story, it's a good story to tell. When you start to ask about the price of the story, there's parts of consumer credit that are still pretty rich out there.
When you start to take a look at spreads, you take a look at yields on high-yield bonds, which are the lowest going back several years, you start to wonder, are we priced to perfection at a time where there still are those downside risks and there is a lag, ostensibly, for Fed policy to work? So it sounds good, but the question of whether you get in is fuzzier, which is the reason why I say there's sort of this dissonance right now where the downside risks are there and growing, but people are banking on the Fed rate cuts in a way that they never have before and are hoping that the Fed can do it in time.
More on those consumer-facing companies a little bit later this morning. Again, Target earnings dropping at about 18 minutes' time, so look out account for that. Equity futures on the S&P, no drama here whatsoever, just about positive on the session. Let's take the opportunity to get you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. A third day of search and rescue efforts is underway around a sunken yacht near Sicily, Italy. Passengers, British tech entrepreneur Mike Lynch and Morgan Stanley International Chairman Jonathan Bloomer are feared dead. Lynch, Bloomer, and 4 others are still missing after the yacht was hit by a type of overwater tornado on Sunday. Crews aided by military ships and helicopters have been searching since Monday. 6 guests, including Lynch's wife, and 9 crew members have been rescued. 1 person has been confirmed dead. Sephora is cutting hundreds of staff in China. It's attempting to turn around a loss-making operation in the world's 2nd largest economy. The LVMH-owned cosmetics giant has fired both office and store staff and has persuaded others to resign. Sources told us that an estimated 10% of more than 4,000 employees in China will be let go. A Sephora spokesperson saying the brand is streamlining and its structure in order to bolster long-term growth capability. Barack and Michelle Obama fired up Democrats in addresses that capped the second night of the DNC in Chicago. They criticized Donald Trump and pointed to Kamala Harris as the heir of their historical political legacy.
We do not need 4 more years of bluster and bumbling and chaos. We have seen that movie before, and we all know that the sequel is usually worse. America's ready for a new chapter. America's ready for a better story. We are ready for a President Kamala Harris.
The former Democratic president also drew parallels between his historic run and Harris's rise to the top, but warned of a tough race ahead. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, contrasting visions for the United States.
I like to say the Republican Party is now the party of common sense.
This is not just about us versus Donald Trump. This is about 2 very different visions for our nation.
The latest from the DNC in Chicago with Anne-Marie up next on the program, live from New York City this morning. Good morning.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching The Close. Welcome to Balance of Power.
This is Bloomberg.
Live from New York City, welcome to the program. Your scores look like this on the S&P 500. Very small, mild losses in yesterday's session. Very small, mild gains in this morning's session. So far, the S&P up by not even 0.1%. Under surveillance this morning, contrasting visions for the United States.
I like to say the Republican Party is now the party of common sense. Conservative, yeah, I guess conservative, it doesn't matter. It's the party of common sense.
This campaign is not just about us versus Donald Trump. This is not just about us versus Donald Trump. This is about two very different visions for our nation.
So here's the latest. The DNC continuing today with Vice Presidential pick Tim Walz set to speak tonight as Donald Trump continues his counter-programming campaign, holding a rally on national security in North Carolina. Anne-Marie joins us now from the DNC in Chicago. Good morning, Anne-Marie.
Good morning, John. You can see the swing states are really in play right now as we were just a few months out from November 5th. Last night, after the roll call at the DNC, which was filled with a tremendous amount of energy and also some cameos like Little John showing up for Georgia, Kamala Harris was about 90 miles north from where I'm sitting now in Wisconsin, in Milwaukee, a state that is a must-win for the Democrats, part of the blue wall. And Milwaukee, so interesting at Pfizer Center, where Donald Trump just a month ago was giving his acceptance speech. And then, of course, today you have Donald Trump on the campaign trail, notably in North Carolina. Just yesterday, Center for Politics, Kyle Kondik, put North Carolina in the lean Republican camp to now a toss-up. This is so important because we heard from President Barack Obama last night here in Chicago. He was the last Democrat to win that state in 2008. Prior to that, it hadn't gone for a Democrat candidate since 1976, and now is it considered a toss-up. So you can see how tight this race is. But what really stood out to me yesterday, whether Kamala Harris saying this in Milwaukee or Barack Obama talking about this at the end of his speech, they said, do not give up this moment. The torch has been passed, said Obama, but now it's up to all of us to fight for America. We believe it, and make no mistake, it will be a fight. They're trying to say, despite all this energy, he talked about despite all this excitement and the memes that are coming out, this is a toss-up election, and that's very clear today and last night, depending on where you see both these candidates.
Something uniquely American about Kid Rock versus Lil Jon. Don't you agree? Ramo?
I guess.
You're not going to see that anywhere else, are you?
Why is it, though? I'm serious that we have this sort of comparison of celebrity music stars in all of these events.
I don't like it either.
Okay.
I really don't like it either. AMH, thank you. Thanks for the update. We'll catch up with Anne-Marie a little bit later this morning. Terry Haynes of Pangea Policy has the following to say. Trump is trying to move issues and get more disciplined this week. That's a good thing, but Trump is still not coordinated and focused. Trump is just speaking to the already converted when he should be trying to broaden his appeal. Terry joins us now for more. Terry, we've got the DNC, that's ongoing. I think we're all focused on September 10th, circled on the calendar. That debate, the face-off between the two candidates. What is that debate going to be like from your perspective?
I think what you're going to see, John, is a battle of message focus. So Trump will be counseled again and again and again to focus message on Harris's record, the Biden-Harris administration's record, and frankly, I think you're going to hear and see a lot about what's gone on in San Francisco and other cities in the last few years. You're also going to hear about Walz in Minnesota and Minneapolis in 2020. They'll make an economic pitch. Harris is going to be all about the future, all about what's next, and you'll hear that one great word that comes out of Democratic conventions: hope and change. She's going to be the hope and change candidate. I think it's already clear from this convention. But she'll stick to message very hard. So Trump can't wander.
You talk about how it's hope and dreams in the future. You also call it spaghetti politics, that basically you've got things being thrown at the wall in terms of policies that will not be made into law. And you start talking about what do we actually know about her framework going forward, about her economic policies, et cetera. Is there anything that we have learned, other than a lot of these policies are not going to see the light of day? Is there anything that we've learned about the difference between Kamala Harris in 2024 versus Kamala Harris in 2020?
I said on your program a while ago, and I'll say it again, Harris is a shapeshifter, And I don't think that's a bad thing. I think that's a good thing in a politician generally, because you're adapting to circumstances. Her at the top of the ticket this time out, leading a party, is not about personal preference. It's about leading that party and moving forward, and then attracting people who might not be, fully in your party, but are sympathetic to your ideas. That's really what she's trying to do right now. That's a very different Kamala Harris than trying to attract primary voters in 2019 and 2020. So, I don't expect that she's going to be the same. I don't expect, consistency in her view. They're very different perches.
I expect it to be consistent over about a week, though, Terry, and policy seems to be shifting from day to day. It was price gouging leaked to the press last week, and then it was kind of, but not really. What are the key policy initiatives coming out of the campaign?
Well, I think by and large what they're going to do is, judging by what Harris says and what's in the Democratic platform, it's not hugely important, but it matters in terms of how the rank and file think about these things. You're going to see a continuation of Biden policies by and large, which include greater government investment, and they hope greater government taxation at root. But what that means in large part is you're not going to see any attention to getting fiscal under control or getting debt and deficit under control, and that seems to be the primary preoccupation of markets when you look at what comes out of Washington.
We've talked a lot, Terry, about how this is all about vibes and good feelings, and then we saw that with the RNC, and now this is the DNC. What strikes me is that this ultimately is a party that is being unified by the anti-Trump rhetoric, by basically running against Trump, not Trump again. How far do you see that getting this election, this campaign, given the fact that at some point people may look beyond that?
Well, unifying your party is job one, and Harris is doing that. One of my critiques about the Trump campaign is I think Trump is not doing that. Trump is unifying his base, which is not the party, and is not making effective outreach to consolidate that party support, and not reaching out to independents effectively, I think. So Harris is doing what she needs to do this week, but going forward, it's very clear that what they're going to lean on is concern about social issues plus fear of Trump as the motivating principles.
Terry, thanks for your input this morning. Thank you, sir. Terry Haynes there of Pangea Policy on the latest on the campaign trail for both the Democrats and the Republicans. Can we pull up the price of gold just briefly? Pulling back from all-time highs, but still around 2,500. Stat of the week. I think stat of the week comes from Jack Whittles over at Bloomberg, or rather here at Bloomberg. The milestone that we reached on Friday, when we crossed 2,500 per troy ounce, an all-time high. Gold bars typically weigh about 400 ounces. That would make each one worth more than $1 million. Have you ever held a gold bar?
They're incredibly heavy.
Super, super heavy. $1 million a gold bar now.
So I've heard this, and I have to confess I haven't been to one of the vaults at the bottom of a bank. If anyone wants to give me a tour, would love that. But evidently people wear steel-tipped shoes, because if they drop those bars, they will break their toes. That is how heavy these bars are. And now they're heavy in terms of a monetary sense as well. The why is what I find interesting. Is this because of the deficit, or the deficit is going into gold, or is it because of central bank buying or something else that's going on?
Lots of reasons. At the Austrian Central Bank, if you ever find yourself in Vienna and you can go into the Austrian Central Bank, there's a game that you can play. You put your hands through and you try and lift the gold bar and pull it out, which of course you can't do. I've no idea if it's still there, given that it's now worth $1 million, and when I was last there, it wasn't.
Can you keep the gold bar if you're able to?
It's just
pick
impossible.
It up?
It just doesn't fit.
Yeah.
It just doesn't come out.
What if you're just amazing?
Like a magician.
Yeah.
Then
Good luck.
Good luck.
Okay, we'll check it out.
the Vivian Tom clientele.
Yeah, power women, like the dragon. Dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world.
Why do you position your products for this group of women?
When I started, designing, I always want to do something that is empower women.
When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example.
My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, They are like in the 20s, so it's a more affordable price for them. And then, my powerful women's daughter wearing their mom's dresses, and they feel that the power, the energy. So now they come back to the store and they buy more.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
In just a moment, we'll get numbers from Target, or as Target, as TK liked to call it back in the day, Target.
It wants to be Target now because Target sounds high-end, and they don't want to be high-end because evidently not being high-end is probably the way to go.
That's smart. Things have changed. It's Target. Again. And those numbers drop in just a moment. So Lisa's going to break them when they drop across the screen. Let's start with the price action elsewhere. The scores on the S&P 500, just about positive by almost 1/10%. On the NASDAQ, we're just about unchanged. On the Russell, we're positive by 1/3 of 1%. As Target drops, I'll just bring you some yields in the bond market on a 2-year, 10-year and 30-year. If you switch at the board, we look a little something like this. The 2-year yield higher by almost a basis point, 3.99. Lisa, what have we got?
Well, it looks like Target is following a similar type of story as Walmart. Comp sales in the second quarter up 2%, or almost double the estimated 1.07%. The full year adjusted earnings per share forecast is from $9 to $9.70. It saw previously $8.60 to $9.60. The estimate was $9.22. You could see the shares popping in pre-market trading. What I find interesting here is essentially people who said that Walmart's gain was everybody else's pain are not seeing that trickle through in Target, which always has been number 2 when it comes to this company. Looking at revenue rising, comparable sales rising, talking about how you are seeing margins that are continuing to expand. So we'll keep digging through all of these numbers. What it highlights to us is that, frankly, it is not an anomaly that Walmart did well, that the consumer can still spend, and even if they're looking for value, they are still using their hoards of cash to keep deploying.
The takeaway pretty straightforward this morning. The stock is up in the pre-market by close to 10%. That's the knee-jerk reaction to these results. Higher traffic in stores, rising online sales. The line coming from the CEO, we made a commitment to get back to growth. Our team delivered. We're staying on offense. Lisa, we heard this from Andrew Sheets of Morgan Stanley about 30 minutes ago. What's happening with consumer cyclicals, what's happening with staples, and what's happening within retail? Some companies seem to be doing a much better job of executing than others.
This is the CEO in another comment saying, I think we see an incredibly resilient consumer in the face of high inflation and some of the other challenges that have been facing to manage their household budget. These are executives that want to seem sensitive to the average plight, and yet they are seeing consumers that are willing to spend. Basically, does raise a question to your specific point about whether to go into consumer cyclicals. Are we seeing the beginning of some sort of recovery cycle that will be fueled by a Federal Reserve dropping rates? Or are we seeing something that's already been priced in fully at a time when potentially we haven't fully seen the lags?
Well, let's go through the different retailers. So Walmart, decent, Target, good. Based on these numbers and the price action this morning, okay. Let's move on to Home Depot and Lowe's over the last week, both cutting their outlooks. Home improvements a real struggle. If you go to the food industry, let's go to fast casual restaurants. Let's go to fast food, Lisa, more broadly. There is a promotion every single day, everywhere you look, when it comes to those businesses. So different companies experiencing a very different consumer at exactly the same time.
At a time when people are looking for value and they're trying to get it in a lot of different ways, some people will read into that because the consumer is strapped and they don't have that much money to spend.
Other people could look at it as, for the first time, you're seeing real consumer pushback to inflation that had been running at the fastest pace in decades. And suddenly, this sort of speaks to disinflation with a consumer that's willing to push back and do what a lot of people wanted them to do, say, a year ago. If the labor market doesn't fall out, this is actually a very healthy recipe for disinflation and ongoing growth.
Get that stock on the screen. We're up by 10% in the pre-market on target as that company and those earnings, sales swing to growth. Much more on that story a little bit later. Of course, we get numbers later this morning from TJ Maxx. We'll hear from Macy's as well. All of that coming up throughout this morning. Target up by more than 10%. Elsewhere, I want to turn to this story. Day 3 of the DNC getting underway in Chicago. Vice presidential pick Tim Walz is the headline act scheduled to speak tonight. Donald Trump continues his counter-programming tour with a rally in North Carolina. And on a program like this, we're laser focused on what is and what isn't happening with economic policy. Last week, it sounded like a really aggressive push to really clamp down on price gouging, whatever that is and wherever it might be. They seem to have backed away. The campaign seems to have backed away from that big time. If you missed our interview with Mike Parr, the economic advisor to Kamala Harris yesterday, I suggest you go and have a look at that conversation, because that conversation did not sound like some of the conversations we heard last week.
Building on prior legislation, existing legislation to deal with emergency situations where there could be specific companies that are bad actors is very different than saying we're going to go after companies for raising prices too much on a broader sense. Look, a lot of people saying that this is not really going to stick. That's the reason why we heard from Terry Haynes, spaghetti politics. It's sort of to give a sense of empathy, a sense of understanding the plight of people who are grappling with faster inflation. That said, it really does leave a blank slate as far as what policies are actually going to put into effect, whether it's Kamala Harris or Donald Trump, considering that Donald Trump 2.0 may be somewhat different from Donald Trump 1.0.
It's pretty confusing, isn't it, when it comes to both candidates right now, the kind of policies they kind of want to introduce. When you listen to the campaign, the Harris campaign in the last week, big push to clamp down on price gouging, maybe even price controls, big fear about the outcomes of those kind of policies, then backing away from that on the campaign in the last 24 hours, the last 48 hours. When it comes to home building, there seems to be something concrete there. They want to incentivize home building. At the same time, they want to address the inability to buy in America by helping people with down payments. And we talked about what would happen to prices. I think all roads lead to the Federal Reserve and a lack of inventory when it comes to affordability in America. We'll be talking about this with a home building analyst a little bit later this morning at about 8:15 Eastern time. We'll catch up with UBS. You've got to think about the difference between the effective mortgage rate right now and the market rate right now. The effective mortgage rate in America, so the average rate on outstanding mortgages is running at about 4%, right? 4%. The market rate, a little south of 7%. That's a big spread. And that's why we've got this massive lock-in effect. The leases of this world that will not put their house on the market because they do not want to leave these mortgages behind. But
Why?
You're not alone. There are so many people in that seat. So when we talk about affordability in America, a lack of inventory, really we're talking about the Federal Reserve, aren't we?
Well, that's the reason why we heard from Neil Duddy yesterday that he's looking at something like a 5.5% mortgage rate, effective mortgage rate, to actually get some of that volume into the market. You talked about this yesterday, and it's a really important point. Yes, this is a supply issue. It is not a demand issue. It is not the inability of people to spend that much more. That's not alone going to bring down prices. If anything, if you give them more money, it will increase the prices and make things even less affordable because of a lack of a supply. If you take a step back, Toll Brothers reported earnings yesterday after the bell. Solid demand for luxury housing. This really is a sort of really key question with the divide of who can buy homes and which homes are available for
I think a lot of people frequenting Toll Brothers maybe not borrowing, right? Cash buyers.
Right. So it's a very different clientele, but it just highlights, I don't know. It's an interesting moment, and it's one that has to do with policy for the builders. If you start to juice the other side of things, it could have a distortive effect.
We'll try and get some numbers on that for you a little bit later this morning. I'm still looking at shares of Target. The stock's still climbing in the pre-market. It's up by 12% now, Lisa, in early trading.
What I find interesting is that shoppers spent more on non-food items, including apparel. We saw this also with Walmart. This isn't just people going to buy staples. This is other, to Andrew Sheets's point, consumer discretionary items. This really does speak of people who have money to spend. Target shares finally turning around after a lot of pretty bleak quarters, up 13%. This doesn't scream of an economy that's rolling over, that's increasingly on the brink of recession.
Big bounce for that stock. early this morning. More on that a little bit later, up by 12.2% in early trading. Let's turn to the latest in the Middle East. Hamas saying it's keen to reach a ceasefire agreement with Israel, adding comments from President Biden and Secretary of State Antony Blinken were misleading. Blinken earlier saying Israel had accepted a proposal for a pause in fighting, and the next step is for Hamas to say yes. Julie Norman of University College London joins us now for more. So, Julie, what's your sense of things? Where do things stand and who's holding up this deal?
Yeah, well, good morning, John. You know, right now, I would say it doesn't look very promising at the moment. The best news we can say is that the actors are not fully walking away from the deal. We heard, as you noted, Hamas saying they are still in this. In fact, they are not trying to hold it up. But the likelihood of a deal coming through soon is unlikely. What's seemed to be the holdup this week is some new conditions essentially really being pushed by Netanyahu that Hamas claims have just shifted the deal to a point where he essentially knows they can't accept it. So this isn't to say the talks are over. They plan to continue, but I don't see anything coming about this week.
Julie, you've been watching this space for a very long time. If you take a step back, would you say that Bibi Netanyahu right now is the biggest holdup?
I would say that right now, some of the conditions that he has imposed since we were very close back in July have certainly kicked this further down the road. And we're hearing that from some of Netanyahu's own colleagues, some of the Israeli negotiators themselves, saying it's been very difficult for them to negotiate effectively because of some of the hard lines Netanyahu has imposed on them. So I think if you're hearing it from those individuals themselves, that is certainly quite telling. Of course, there's been a lot of back and forth throughout these negotiations, and we have to remember, you know, events have been continuing throughout as well. There has still been strikes in Gaza. There was a suicide bombing attempt in Tel Aviv this week. Bodies were recovered from some of the hostages. So conditions on the ground are shifting very quickly for both communities also.
There's a larger question that we really haven't gotten a clear answer on, and it might not be possible to get one, which is how much could some sort of ceasefire agreement stave off this sort of specter of an Iranian retaliation? Is this something that can be de-escalated with an agreement, even if it is tentative? What's your take on that?
Yeah, well, one of the reasons that a ceasefire is so important, I mean, obviously we focus mostly on Gazan civilians, on Israeli hostages and their families, but a ceasefire means so much more for the region right now. It is really the key linchpin for preventing further escalation on the northern border with Lebanon and Hezbollah, which has been escalating quite rapidly. It's very important for staving off this potential retaliation from Iran, though that seems to be slightly delayed as it is, and as well as from continuing operations from Yemen, from Houthis in Yemen against shipping, which has cost over $1 trillion to the world in shipping costs. And so I would say there are so many other things going on in the region that are linked so much to this ceasefire. And I would point out, too, all of these elements also include the U.S. A broader regional escalation will draw in the U.S., whether Harris, Trump, any future president wants it or not.
Julie, we caught up with Amos Hochstein earlier this week, advisor to the President of the United States, and he certainly gave us the impression that there was a big opportunity to strike a deal here, an opportunity that maybe didn't exist in previous rounds of talks. And Julie, what we were trying to figure out was whether that assessment was shaped by facts on the ground or just informed by the political calendar. It was something they were wishing for, given there was an election coming up in November in this country. Julie, do you think it's informed by the facts on the ground or shaped by the political calendar?
I would say it's a bit of both. There's definitely been some wishful thinking, I think, from Washington with the clock ticking down and knowing this is the real last moment for them to lean in their shoulder. With that said, again, everyone knows that this moment is extremely tense. Again, this risk of a Iranian and or a Hezbollah retaliation did seem to put the pressure on for some kind of ceasefire deal. At the same time, again, the operations in Gaza have really put the pressure on Hamas. So in terms of there being a need for this right now, that is quite ripe, and yet we see it very difficult getting it over the line. I think right now the best we can hope for is another pause, some kind of at least first phase of this wider deal that's been talked about, but the broader deal itself still seems quite a way off.
Julie, appreciate your perspective, as always. Thank you. Julie Norman there of UCL on the latest in the Middle East, the latest on Target. The stock is still climbing. Let's get you an update on that and more with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John, that's right. Target is surging up some 14.4% in the pre-market trade. It ended a string of sales decline in the second quarter, and it cited improved discretionary discretionary spending. The retailer also said that comparable sales rose 2% in the quarter. That is higher than the average estimate of analysts, while breaking 4 straight quarters of contraction. Earnings per share also beat expectations. It is the first sign of a turnaround at Target after higher inflation and interest rates prompted consumers to pull back from big purchases and spend less on discretionary products. China has launched an anti-subsidy investigation into dairy imports from the EU. It's just the latest in a tit-for-tat trade dispute. This probe, though, targets several dairy products, include fresh and processed cheese, according to China's Ministry of Commerce. It will also review 20 of the bloc subsidy programs. Europe expanded tariffs on Chinese-made EVs, saying yesterday it plans to introduce a 9% tariff on Teslas imported from China. Now, relatedly, Xiaomi reported its fastest pace of revenue growth since 2021. The Beijing company has seen initial success with its first electric vehicles, putting it in direct competition with the likes of Tesla and BYD in China. Now speculation is growing that Xiaomi has its sights on the European market. They showcased one of its electric sedans during the Paris Olympics, despite the EU's tariffs. Xiaomi also reported a recovery in its smartphone business. And that's your Bloomberg Brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, running the risk of falling behind the curve.
For the Fed, if all you're going to do is string out a bunch of 25 basis point rate cuts, I mean, it could take a long time to get to neutral. And the further the Fed is away from neutral, the more the risk to the economy.
A preview of some big revisions to U.S. jobs data up next. You're watching Bloomberg TV.
There are many global investors that aren't interested in China anymore, but there's a lot that are. And obviously the local investors have money in China and are doubling down on investing in China. Many of the Asian investors, and in fact a lot of the Middle East investors, the Americans are gone away. Therefore, there's an amazing opportunity to put capital to work and get returns which are excess what you would get in other places. Where there is lack of money, there is usually opportunity. So we continue to build out our business in China. It's just where the money's coming from is different. And so we're raising local money in China for investing and bringing those that choose to be there to invest in China. So it's just a different, where the money's coming from is just different.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Check out shares of Target. That stock is up in the pre-market by close to 15%. We're up by 14.5. Target ending a string of sales declines. Pretty flat, that stock price on the year so far. Elisa, it's not flat anymore.
Yeah, it's basically up about 1% on the year versus a 17% gain on the S&P 500. Well, we just basically brought it up to speed with the rest of the S&P just based on pre-market trading. They did cut prices on some of their grocery goods, which is part of what they are saying lured people into the stores. But what I find interesting is what people spent money on. It was the non-food items. It was apparel. It was the things that they were not spending on when they were supposedly more concerned about some of the inflationary risk. Again, this and Walmart together, not speaking of a consumer running out of steam.
Not at all. That's the latest from Target, the latest from TJ Maxx, and the latest from Macy's, all coming out throughout this morning and today. Under surveillance this morning, running the risk of falling behind the curve.
if all you're going to do is string out a bunch of 25 basis point rate cuts, I mean, it could take a long time to get to neutral. And the further the Fed is away from neutral, I mean, they're very restrictive by their own admission, the more the risk to the economy, given the fact that they're very far from neutral and the fact that the data on net has been somewhat weaker than expected. I do think that kind of supports larger moves at the outset.
Here's the latest payrolls revisions from the Bureau of Labor Statistics due at 10 a.m. Eastern Time. Economists expecting the data to show U.S. job growth for the year through March was much weaker than estimated. Torsten Stock of Apollo shaking off the weakness and focusing on the strength. Daily and weekly data shows that retail sales are strong, jobless claims are falling, restaurant bookings are strong, and air travel is strong. The bottom line is that there are no signs of a recession in the incoming data. Torsten joins us now for more. Torsten, good morning to you, sir.
Morning, morning.
Let's start with these revisions that come in a few hours' time, and I'll share the estimates that come from Goldman, and the range is this wide, okay? It's anywhere from something like 300,000, 600,000, or 1 million. Anywhere from 50 to 85,000 per month. What do you make of these numbers? JP Morgan 300 and something, Goldman 600 to a million, revised a little bit later this morning.
I think this is important for the economist, and this is important also for the Fed, but it really is not important for markets. This is looking back in history and trying to figure out how much did employment grow, and if employment grew a little bit less, then yes, of course, overall, that does send a little bit different signal about where we are in the business cycle. But broadly speaking, I don't think this will get much weight in financial markets.
What do you think is normal? What's the normal run rate now for jobs growth? Is it the 114 of the previous month?
Well, so there was a very important paper by Tara Watson and Wendy Edelberg from Brookings, or the institute that produced some estimates that says that we will probably have employment growth for the near term at around 200,000, a little bit below. So if that's the case, because of immigration playing such a big role, we should also see a boost to non-farm payrolls. But that's probably going to, over time, fade, so we'll probably get down to the long-run estimate, which we would estimate to be around 100,000.
It begs the question why we took last month so seriously if you don't think we should take the revisions that seriously.
Well, but that's also why jobless claims for the last few weeks have been signaling that everything is just fine. If you also look at a broad range of other indicators, as we just ran through, both with travel, with restaurant bookings, hotel bookings, also look, broadly speaking, at how many companies go into default. There's weekly data also for that. We also have a general picture that the economy is just not slowing down. This whole narrative, as you just spoke about with Target, Walmart, TJ Maxx, this whole narrative that we are slowing down is just not evident in the data. So that's why I think that we should, in markets, think about the outlook for the Fed with that backdrop.
You've said in the past, over the past few months, that you didn't think that any rate cuts were necessary. This comes at a time, at least not this year, this comes at a time we've got 100 basis points of rate cuts being baked into the market, and you're saying that it's likely, most likely, that the Fed is going to go next month. What do you think the consequence will be of a Fed that starts cutting next month at a time when you still, sounds like, don't think it's necessary?
Well, that's why, as Neil Dodder was just saying, there is this whole concept that we are way, way too restrictive. But that is only if you have R** or where the Fed is going at a much lower level, maybe I say 2.5 or 2.8 as the long run dot says. Then it's true that we are restrictive. Then you need to see the Fed cutting rates quickly. But what if R**, what if where we're going is more close to 4, 4.5? Then we're not in a hurry. So the main test of the answer to your question is, what is the incoming data telling us? The Fed last hiked rates in July of 2023, and still now, 12, 13 months later, we're still waiting for the data to slow down, and it's not happening in any meaningful way. So if Godot didn't arrive here over the last really 18, 24 months, why should Godot arrive in August of 2024?
Some people say Godot is leaving his sort of remnants in different places and giving us a sense that maybe he's more present than we previously thought. And we're pointing to potentially some of the retail sales or some of the negative readings into the non-farm payrolls that we got a couple weeks ago. At what point do you say we still do not need rate cuts, that you have conviction based on all the strength you were just talking about, that Godot is not around, Godot is not coming, and that actually this is a very different environmental environment for the economy?
Well, I think we see that reflected in speeches by different FOMC members. Some FOMC members, including Nikki Bowman, have been saying, well, hold on, I need more evidence that we should cut interest rates. Others are more convinced. So getting the committee together for Jay Powell and making sure that the committee is moving gradually in the direction of interest rates moving lower, that does take some time. So I think they have agreed now that they will cut interest rates 25 basis points in September. But after that, I think everything is open because the data, it's not slowing down. And again, the retailers reporting earnings directly, the Walmart CEO said, we're not seeing broad-based slowdown for the consumer. We need to take that seriously when that's 70% of GDP. So yes, I do understand that in markets, we quote-unquote want the economy to slow down, and we're so hooked on the narrative from the Fed that interest rates need to normalize. But we have plenty of time for normalizing interest rates. So that's why let's get that rate cut here on September the 18th, and that's what Jay Powell will say here at Jackson Hole. But after that, I still think that they are open to, well, let's wait and see exactly how the data plays out.
Torsten, it just seems to me and to most people that the focus has shifted to the other side of the dual mandate. There's a focus now on the labour market, and even if you're confident, constructive about the future for risk mitigation, risk management purposes, you want to reduce interest rates a little bit from here. Maybe you go 25 and you go 25 again. But it's the other side of the mandate that has been completely neglected over the last 2 months, I would say. Inflation. You mentioned Governor Bowman. Governor Bowman talked about upside risk to inflation, reiterating her concerns, went through a long list of things: increasing geopolitical tensions, additional fiscal stimulus, and increased demand for housing due to immigration. Do you think we should be a little bit more focused on the thing we've been ignoring for the last couple of months?
So let's be, of course, clear that inflation did peak at 9.1. Now we're at 2.9, so we are a lot closer to the 2% target. But last time we looked, 2.9 is not 2. So that's why I think she's highlighting, and several other FOMC members are bringing up the same points and saying, well, let's wait a little bit and just make 100% sure that we're still moving down towards 2%. Because the risk is, of course, that if inflation does start to move either sideways or in the worst case move higher, then they will need to go back and revise their strong, just like they did in the beginning of the year. They said we have 3 cuts, now it was just 1 cut. So now the market is really getting ahead of itself. Remember also during the VIX episode and the carry trade unwind from Japan, the market was pricing that Monday that the Fed would cut 6 times. So that's why the roller coaster ride here in terms of what the market is pricing, it's important to anchor your expectations around what's the incoming data actually showing.
So when we talked to you a couple of months ago, you were saying that you could see the strength in the market certainly continuing through the end of the year on the heels of data that continue to be more resilient, stronger than people expect. But that next year, it could be a problem, that you could see that fall off a cliff. Have you changed your view as you see a greater likelihood of a Fed rate cut and the potential for maybe some of the pressure to be eased before next year?
Yeah, because I do think that the main reason why the economy is holding up so well at the moment is that there's a significant tailwind from, broadly speaking, a higher stock market, tighter credit spreads, and easy financial conditions across the board supporting the economy in a very broad way. And because of that, that does mean that now we have had some correction in the Magnificent Seven. Now that stock markets are beginning to show some signs of wobbling a little bit more. They have rallied, of course, here after the carry trade unwind. But if there is any reversal in the strong tailwind from the stock market, then it would begin to have some implications, in particular for middle-income and high-income consumers, both those who own the S&P 500 and own their home, but also those who own credit, private credit included, where the cash flows have been basically the best levels in decades. Anyone who owns fixed income are seeing cash flows on the consumer side that are very, very strong, and that continues to be a very important tailwind to the economic outlook.
Torsten, it's been far too long. Let's do this again soon. It's good to see you. Torsten Slok there of Apollo. Much more on that debate in the next hour of Bloomberg Surveillance, and of course this move in Target. That stock is up in a pre-market by more than 14%. Up next on the program, Seema Shah of Principal Asset Management, Libby Cantrell of PIMCO, Jennifer Bartashas of Bloomberg Intelligence, and Anders Persson of Nuvi from New York. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
What would you say somebody young who's watching this should do if he or she aspires to be like you?
There's one component of our industry that people need to focus on, and it's not technical, and that's communication.